Hello, my name is Andy Agafangelo. I'm the founder of the Transparency Task Force. The Transparency Task Force is a UK-based certified social enterprise. We have a mission we take very seriously. The mission is all about encouraging the financial sector to behave better. We want it to be more transparent, more truthful, more trustworthy. And what we've learned more than anything else over the last 7 years is that the regulatory framework is failing to govern the financial industry, which means that it is routinely behaving in a manner that it shouldn't be behaving. I'm going to talk about 3 words: corruption, collusion, and cover-up. Those 3 words do, I assure you, I promise you, those 3 words do relate to what we are going to be discussing this evening: corruption, collusion, and cover-up. There's no real doubt about it at all. The evidence is there to be seen for those that have got the ambition, the integrity, the tenacity, and the courage to go looking for it. And the speakers you'll be hearing from tonight are going to be sharing that evidence base with you and their insights. Those 3 words, collusion, cover-up, and corruption, also relate to an outstanding event that happened yesterday. An event that, quite frankly, was the most moving and emotional and motivating meeting I've ever been to in my life. I've never felt so shocked and ashamed and embarrassed and angry as I felt during the meeting in the UK Parliament that took place yesterday evening, when Andy Verity and others talked about this. The book called Rigged, as you can see, Rigged is the incredible true story of the whistleblowers jailed after exposing the rotten heart of the financial system. It's a truly remarkable book. I will be putting a link to it in the chat. If you haven't yet bought your copy, please do so. I mean what I'm about to say literally. If anybody buys that book and doesn't think they got good value for money, tell me and I'll repay the cost. I mean that literally. I want as many people as possible to be buying the book. The reason the book is so important is because it builds an irrefutable case showing the collusion, corruption, and cover-up that's been taking place. And this doesn't just impact the people in the UK, it also impacts people in the island of Ireland too. All that's going to become clear. I'm going to invite, first of all, Steve Middleton and then Andy Candy to share their thoughts about why the meeting in Parliament yesterday was as powerful and purposeful and poignant as it could possibly have been. Steve, can you go to that point first of all, please, sir? Thank you.
Yeah, it was an excellent event, Andy. Well done to you and the team for organising it. It was shocking. Harrowing is the word I've used that I've spoken to people about, because it's an example of what the culture is in this country in terms of protecting the people at the top and how those people are protected. And I'd only got a short way into Andy Verity's book because I only received it on Monday. So I'd already come across a chap called Peter Johnson, who was he was the LIBOR submitter at Barclays. And what stands out straight away is that Peter was a very straight guy who wasn't happy about being told to reduce the rates on LIBOR as they were being doing, not by the bank, but by the Bank of England. And effectively, it was as the credit crunch happened, there were concerns about banks having high LIBOR rates because people might think they're in financial difficulty and there could be the risk of a run. And Peter was submitting rates early on at, say, 5.4, 5.5%, which were the rates he was able to borrow money at. But the rates that were going in from the other banks were 20, 30 bips below that, 5.2, 5.3. And he couldn't understand it. And he started reporting it internally, all the way up to the directors and externally to the FCA, and saying, look, this isn't right, because we should be submitting honest rates here, yeah, and lowballing, as it's called, is a criminal act, yeah, because you're submitting false rates. And he did that. The FCA said, or FSA at that time said, they weren't responsible for libel and passed it on to the BBA, who did nothing. But eventually what kept happening was, as he submitted honest rates, he was put under immense pressure to come down on those rates or reduce them, to the point where he was even 0.5% difference between the rates he wanted to submit and what were being submitted by everyone else. And it was Paul Tucker at the Bank of England and the Bank of England and the Treasury putting pressure on the banks to get these rates lower. But it wasn't just in the UK. This was the Fed, the Bank of Japan, central bank. Globally, there'd been an agreement that this is what they were going to do to keep it looking as if banks could still borrow money at reasonable rates. And the reason I'm talking on about Peter is Peter was there last night. And what I didn't realise is that he later went to jail. So this was a person who was reporting the wrongdoing, correctly so. He was later targeted. So after 30 years at Barclays, he was targeted and was sent to jail for, I think he had 2 years on remand, 2 years in jail, and I think 2 years was it on licence down, and he's still a convicted criminal. Lost his pension, lost his home, nervous breakdowns, family breakdowns. You can imagine this kind of thing he went through. And he was one of three. There was Tom Hayes there as well. Tom, same thing happened. Tom went to jail for about 4.5 years. He was one of the better known ones. And he didn't see part of his son growing up. His marriage failed. He got multiple sclerosis diagnosed when he was in prison. And Carlo, unfortunately, I don't remember Carlo's second name. You'll know it, Andy. Very nice.
Carlo Palumbo, a lovely, lovely man.
Carlo Palumbo, very, very nice guy. He was devastated because even when he'd gone home to Italy for the first time after being out of prison with his young daughter, his mother and aunt wouldn't meet with him because he was a convicted criminal. Now, what is so shocking about this is these guys did nothing wrong. They actually weren't convicted of lowballing. That is the criminal act. They were convicted of doing standard trading. So when they were getting libel submissions, they could pick on a range of those submissions, and they may get a trader from New York or Hong Kong say to them, can you do me a favor? If it's 5.3, it'll be better for my trades than 5.35 or 5.4. All of that is permissible. It's not illegal. But the UK, and again, I didn't realize this, apparently brought in a law in 2012 that made that a criminal act retrospectively. So what they did at the time was not in any way a criminal act. Yeah, and throughout the rest of the world now, and in America, the cases on this failed because it was deemed that what they had done was normal standard trading practice and everyone was doing it. Apart from in the UK, yeah, these guys went to jail and are still classed as criminals today. They were saying they can't drive cars because they can't get insured as criminals. They can't insure their homes. They can't get a mortgage. They can't even think about getting a job. I mean, it was absolutely horrific and shocking that that was what happened in the UK to take the pressure off investigating the Bank of England and the Treasury and the government who actually did the criminal behaviour. Absolute scapegoats, horrific. But I'll let Andy tell you a bit more about it.
Steve, thank you very much. Just to correct the record, TGF didn't organise the meeting. We supported it. It was organised by Andy Verity and his team, but we were very, very proud to play a part in helping to raise awareness of it. But just to correct the record, it was an absolute cracking meeting. There was standing room only, quite literally standing room only. Thank you, Steve. That's superb. Mr. Andy Candy, please do share your thoughts about last night. Thanks, Andy.
Thanks, Andy. I'm not sure I can really add too much more to what you guys have already said. I mean, it's just an extraordinary event from start to finish. I mean, exemplary journalism from Andy Verity in a presentation that was succinct and detailed, but easy to follow and understand given the complexity of the subject, which is something we all struggle with swaps and various other issues that have gone on. But yeah, he delivered it with clarity and integrity. And just, I think the most powerful part was hearing from the traders themselves and the utter destruction that had been wrought on their lives from doing absolutely nothing wrong. Just, I mean, literally 2, 3, 4 emails they were convicted on the basis of, with ignoring of evidence, fitting up, framing, lying, false experts. Just, I mean, you couldn't make it up. You literally couldn't make it up. If you did, people just sit and go, this is absolute nonsense. I mean, I've finished the book now. It's a riveting read, well worth getting, but I mean, it'll just leave you in tattered as to what, as indeed the event did, hearing from the traders and what has happened to their lives. I mean, I don't think there was a single person in there that wasn't choked up or in tears at some point. I mean, it just leaves you absolutely bereft of any hope, dare I say, without wanting to go too morose. But how, I mean, we've all been fighting these crimes and this misconduct by the regulatory systems, but to have it laid on a plate and to see that it goes absolutely to the top, as we've always known and suspected, but to have it there laid out in front of you as succinctly as Andy Verity did, you sort of go, well, this is why we've been in this battle for 10, 15, 20 odd years, because this is what we're dealing with. Utterly ingrained establishment corruption of the most worst kind. It's an abuse of human rights. It's nothing short of it. I mean, criminal, yeah, illegal, fraud, whatever. It's an abuse of human rights. The people that have perpetrated this should be on trial in the Hague. Sorry, I'm having to stop myself swearing here because you know what I like, a good juicy word, as I believe Peter and various other the traders do as well. But yeah, horrific. I'm absolutely raging. So I'll probably stop there before I get carried away. But yeah, exemplary event. Andy Verity should be applauded, and yeah, my heart goes out to the traders and their courage and determination, and to stand up in public and say what's happened to them is equally, another trial for them.
Thanks, Andy. That's superb. We've got a pretty rough recording of it. I recorded some of it on my mobile. We'll check if it's okay to put it out there. It makes sense checking with all the speakers before we do that. We did have permission, but it's some of the points made was just so powerful. I just wanted to check everyone's happy with that. But we'll get it out there for those of you that missed it. Thanks, Andy. Thank you very much. I think Andy used the phrase exemplary journalism, and I mentioned that because we have Joe Lyman with us. Some of you may remember Joe from his BBC days. Joe, it's really good that you're here. Folks, I'd like to invite us to put our hands together to thank Joe for being here, one of the leading journalists. Also to thank the parliamentarians who were here with us tonight, the people who are about to speak, the people who went to Parliament yesterday, the traders who spoke yesterday, Andy Verity for writing his book. So let's kick off the proceedings, folks, with just a bit of applause to recognise the amount of effort and integrity that's going into exposing the corruption, collusion and cover-up that has absolutely definitely been going on. It really is quite shameful. It's our job to shine a big bright light on it. Sunlight is the best disinfectant, that's why we're here. So let's kick things off by giving ourselves collectively a round of applause, and also those who can't be with us, folks. Thank you. Alrighty. Another cracking journalist, author, and so on and so forth, Mr. Ian Fraser. Ian's going to set the scene for us and provide us with a kind of high-level understanding of the commercial and economic dynamics that were at work when all this Ulster Bank Scandal type stuff started taking off. Ian, so grateful that you're here with us tonight. So over to you, sir. Thank you very much indeed. Thank you.
Thanks, Andy. And I'm sorry I missed the Andy Verity event yesterday, but being in Scotland, it's quite hard to make it down for a single event. In this book, Shredded, which was initially published in 2014, but this is a brand new edition that came out in 2019. I have a chapter on Ulster Bank, and it's called Riding the Tiger. It basically describes how Fred Goodwin, or the RBS led by Fred Goodwin, sought to completely change Ulster Bank from being a fairly conservative, fairly kind of Presbyterian type of institution to being a more sort of cavalier, aggressively expansionist, aggressive lender. And this transformation really happened in about 2004. But just a little bit of background is that Ulster was founded in Belfast mainly to lend money to linen merchants and linen manufacturers in 1836. In 1860, it opened its first branches outside Ulster, which were in Sligo and Louth. Then it opened in 1862 in Dublin, in College Green. And then in 1917, during the Second World War, it was bought by Westminster Bank, which later became National Westminster Bank, which then was swallowed up by RBS in 2000. At the time of RBS's acquisition, Ulster Bank's assets were £9.2 billion sterling, which is relatively low compared to what they reached. In 2002, so 2 years later, Fred Goodwin met a man called Cormac McCarthy, who was at that point running a building society called First Active, which had recently converted to being a bank. And Cormac McCarthy was a former KPMG accountant, and Fred used something called his 5-second rule to decide that McCarthy was basically the man he wanted to lead Ulster Bank. And he was prepared to buy First Active in order to get McCarthy on board. So in 2003, he paid £620 million to buy First Active in order to get Cormac McCarthy. And analysts at the time were quite surprised that RBS was willing to pay 3 times book for a relatively unknown Irish lender, just as the Irish property market was beginning to cool. These sort of signals were not taken on board by RBS or Fred Goodwin, and they set about transforming this tightly run conservative Protestant stroke unionist outfit into a sort of turbocharged, no holds barred lender that was determined to become the largest bank in Ireland. And so they set out on something they called the Journey to One, which basically was a program to ensure that Ulster Bank could become the largest bank in the Republic of Ireland by 2012. And they shortened it to J21. There was a whole cult around this journey. It was, different members of groups of staff went away on away weekends where they were entertained by people like, or spoken to by people like Bob Geldof from the Boomtown Rats, who was paid a fortune to appear. And it was, there was a kind of high incentivization program. And I wanted to actually read a short excerpt from my book, if that's okay, which describes what happened. Ulster Bank was not averse to throwing money around as it sought to evangelize J21. Each of the 6,500 staff went on 2-day sojourns to hotels around Ireland to be told where their bank was heading. A video featuring Al Pacino was almost always shown at these events. Taken from the 1999 Oliver Stone film, Any Given Sunday, this featured Pacino as a football coach called Tony D'Amato, attempting to persuade an American football team that was down on its luck to have faith and to fight like tigers. The speech includes words like, "We're in hell right now, gentlemen. We can climb out of hell 1 inch at a time. On this team, we fight for that inch. On this team, we tear ourselves and we tear everyone else around us to pieces for that 1 inch. We claw with our fingernails for that 1 inch." Some Ulster Bank found the film disgusting to watch, but they told me about it later. So yeah, the Journey to One started, and as I said, it gained a cult-like status within the bank. Older, more experienced staff were purged. They were replaced by younger, more malleable staff who were less likely to challenge McCarthy over JT1 and whether it actually made any sense. Basically, savvier insiders, who were often the ones who left, realized that the only way JT1's target of becoming the largest bank in Ireland by 2012 could be achieved was by lending extremely recklessly at crazy multiples on lax terms and weak covenants to customers that other banks wouldn't necessarily take on. But then, of course, in 2005, Ulster embarked on a concerted push to sell interest rate hedging products to SMEs. This was attractive from the bank's perspective as the economy was slowing, and these products enabled the bank to book day one P&L, i.e. all the lifetime products of that interest rate hedging product on day one. And we're going to be hearing more about this from Ian Tyler, Steve Middleton, and Corbett Butler later. So I won't go into the detail of the swaps mis-selling, but basically it was quite obviously mis-selling, and it was almost certainly fraudulent the way these things were sold and the way that the margin credit risk and the commissions were not disclosed to the bank, to the customers, and the amount of money basically that Ulster Bank was making by selling these products was not disclosed, and nor was the margin credit risk. So that was, fraudulent, if not incredibly deceptive. There were lots of kind of periods in the life of Ulster Bank when it embarked on crazy lending, such as lending 326.5 million euros to Sean Dunn in order to fund the purchase of around 5 acres of Dublin 4 real estate, the site of the Jury's Hotel, the Towers, and the Berkeley Court Apartments. So this was an extraordinary deal that was basically agreed by Ulster Bank's Paul MacDonald overnight, because Sean Dunn had returned from Thailand and was desperate to pull off the deal. And Bank of Ireland, Irish Nationwide were also considering lending him the money, but Ulster Bank at that time prided itself on its fleetness of foot, and based on the fact that it could lend Paul MacDonald such a vast sum, all of which was almost all of which was subsequently lost at short notice. The bank was kind of delusional, even when it was obvious that the markets were slowing, that the credit crisis was starting. It still believed that it could walk on water. And presenting to analysts in November 2006, Cormac McCarthy, who was the chief executive, said, "Opportunities for growth are almost limitless in Ireland. We see nothing that would give any cause for concern. All the drivers of growth are there in abundance, and the opportunity is very, very significant." That's what he said in November 2006. By February 2008, it emerged that Ulster had grown its total assets up from 9.2 billion in 2000 to around 55 billion in end of year 2007, in December 2007. That's a 500% increase over 7 years. Profits had grown 210%, rising from 513 million, rising to 513 million in 2007, up from around about 150 million in 2000. Employee numbers had soared to 6,500. The bank really, this J21 thing, I think, is the cause of a lot of the problems, because it was a delusional project from the start. The bank should never have embarked on such a project. It was obvious that it was going to end in tears, but presumably the RBS board, led by Fred Goodwin, signed this off, and Cormac McCarthy set off on this course, as I said, in 2004. The consequence was basically, at the time of, you had a collapse in the Irish property market in 2007, 2008. And RBS, as we know, failed and was rescued thanks to a 45.5 billion capital bailout, but a total rescue package for it and other UK banks of about 1.3 trillion pounds sterling. Of the 45.5 bailout that RBS got, around about 15 billion, which is basically a third, went on bailing out Ulster Bank. So that just shows you that a relatively small part of the RBS empire had among the most severe problems of any, of the whole bank. I won't go into the detail of what happened subsequently, other than two key things happened. One was June 2012, when there was an IT failure across RBS Group PLC. And interestingly, that the chief financial officer, Charles McManus, and the head of GRG in Ireland, which is Global Restructuring Group, both left on the 19th of June 2012, which was during that crisis. So the timing was odd. Personal reasons were cited for their departures. And then there was a rolling series of very questionable sales of loans to Cerberus-owned entities, often with the name Promontorio, including Project Aaron, which was a loan book worth around 5 billion, which was sold for around 1 billion, so for 1/5 of its value, of its face value, to Cerberus. And oddly enough, Kevin Craig, who was director of Ulster Bank's GRG unit at the time in December 2014, joined Cerberus, which is strange. And there could be a possible conflict of interest in a staff member presiding over a unit which basically is charged with milking distressed assets or distressing assets so that they can be milked, and then transferring those to Cerberus, but then joining Cerberus. at the same time as the deal happened. So something strange about that. Yeah, we had the 2.5 billion euro portfolio of loans called Project Oyster, which were transferred to Cerberus in October 2016. And these included buy-to-let mortgages, owner-occupier mortgages, but mainly business loans. And then in December 2016, Ulster Bank admitted that less than 100 of these small and medium-sized enterprises, which had been transferred to Global Restructuring Group, less than 100 of the 2,141 companies and businesses which had been placed in Global Restructuring Group had survived. So that was, I think, an even lower survival rate than what some people know as the Grim Reaper Group had across RBS. And then 2018, Jane Howard, who was former head of RBS's personal banking, became CEO. And at that time, Ulster offloaded a further portfolio of 1.4 billion loan portfolio to Cerberus. That included owner-occupied home loans and 2,900 buy-to-let mortgages. So, yeah, Jane Howard, I think, has subsequently left Ulster Bank. But overall, it's been a disaster. You know, both in the growth period of 2003 to 2008, and then in the unwinding phase of 2008 to today. One could argue that Ulster Bank has been calamitous, disastrous for Ireland, disastrous for its customers, and disastrous for many of its staff. An Irish Times leader, which was published in February 2021, said that Ulster Bank's chief executive, Jane Howard, who was still there at the time, had failed the leadership test, failing 2,800 staff and 1.1 million customers. As it stepped back from being a competitive force in Irish banking, it had been crippled by sloppy lending policies, the financial crash, and the reputational shock of repeatedly locking out customers because of out-of-date technology systems that an increasingly reluctant parent would not update. So I'm sorry to have to present such a terrible story, but overall, yeah, it's not been great. And that's the end of what I want to say.
Ian Fraser, thank you very much indeed. Fantastic. Can we please put our hands together to show our appreciation for Ian's work? Thank you very much indeed, Ian. And of course, if anybody has any immediate questions to ask, please do so. Please do so now. Just raise your hand, either literally or digitally, if you'd like to respond to anything that Ian has just spoken about. If not, we'll swiftly move on. I think we're going to swiftly move on. So let's go straight to Mr. Ian Tyler, and thanks again, Fraser. Mr. Tyler, over to you, sir. Thank you.
Yeah, before I dive into my slides, I just thought it was really important we heard from Ian Fraser first, because it is incredibly important to understand that it was the culture and the lax control environment that actually allowed what happened, the fact pattern that we're going to look at tonight. And it was the most bizarre acquisition because as he's alluded to, you know, nobody in RBS Group looked at First Active. Nobody did any due diligence on First Active. This was a private deal where basically Fred Goodwin decided to buy the bank and told Group and told Ulster this is what was happening. And so the first that the board of Ulster Bank would have known this was happening was that they were told they were buying First Active. And then they were told the next day that, by the way, they are losing their jobs and the First Active management is becoming the new board of Ulster Bank Group. So it's a very, very, very unusual fact pattern in the way that effectively Fred put in a new management team. You mentioned Cormac McCarthy. I think the other person that should at least get name checked today, because he would have had direct senior responsibility, was the CFO at the time, a gentleman called Michael Torpey. He was the CFO at First Active and then became the CFO for Ulster Bank and was responsible for the, you know, as CFO, he was responsible both for treasury, risk, and all the other control matters, accounting. And as we've already alluded, there was a complete failure within Ulster Bank during this period. And maybe the only thing I'll just pick up on directly, The reason why 2005 comes out and is because actually that was the year that the accounting rules changed. It's really important to understand how accounting drives so much of bad bank behavior. Before 2005, RBA, Ulster Bank would have operated to UK GAAP. UK GAAP allowed bad things to happen, but actually, effectively, you could have an internal swap that had asymmetric accounting. So the bank could actually make money by doing a swap with itself and having one end in the trading book and one end in the banking book. And indeed, some of that did go on. I uncovered some of that in 2004 when preparing for IFRS accounting. But actually, the one advantage of that is none of that really directly impacted the customer. It was very poor accounting, but it didn't directly affect the customer. When 2005 came in, IAS tightened that up, and you had to consolidate out intragroup swaps so that you couldn't make a profit out of dealing with yourself. And so that's why the bank suddenly decided, oh, we still need to make a profit. We're going to sell these derivatives direct to customers. So from 2005 onwards, you'll find quite a lot of banks started selling derivatives to their customers directly. So that's just a bit of context before I dive into some slides.
And in fact, would you do so for us? I hope you're planning to do this anyway, but just in case not, I think it's really important that people understand your background. So please do make sure people understand the rather important perspective that you have on these sorts of things.
No, I will do that. I'll do that. I'm just going to get my presentation up so that, and please tell me if you can see this presentation. Can you see this?
All perfect. Thanks, Ian.
Good. Okay, because that's always that's the most stressful bit of the whole thing, is making sure the presentation comes up. So yeah, my background is, well, actually, I worked for major banks for most of my career. I've done consultancy in that space since, but actually in 1999, I left a small Scottish bank called Royal Bank of Scotland and joined NatWest at their group treasury in Lothbury. So I did know the old style Ulster Bank, which, as you rightly said, was very conservative with a small c. And I actually was the group. I sat on their ALCO. I knew their business really well. But you're right, when RBS, with the city's blessing, took over NatWest, the culture changed, the balance sheet grew. And I basically stood at the center of RBS's balance sheet as it was, managing liquidity, managing interest rate risk. And in 2008, I was actually given the worst job possible. I was asked to look after capital for RBS, just as RBS was facing into the most difficult time in its life. And the group FD said, this is the most difficult job. So I've been at the center of these groups. I understand the nature of risks. And I thought today that what might be really helpful is just for me to do a little teaching on swaps, because I am literally gobsmacked by how we can still have court cases where judges make decisions based on completely incorrect fact patterns, i.e. they completely ignore the key features of an interest rate swap. And that's because, well, it has to be ultimately because of a sustained misinformation. Again, Swift, who did some good stuff in his report, he doesn't even touch on some of the key features of an interest rate swap. And if I was spending 8 million quid on getting a report written into the review of interest rate hedging products, I would have got somebody who actually understood derivatives to do that review. And the FCA, well, I almost have no words for them now, because they have failed time and time again to take any effective action. So if you bear with me, I'm going to just give you a short lesson on the key features of an interest rate swap. So there's only 4 slides. I've kept it really short and as simple as I could possibly do. Why do people use swaps in the first place? There actually can be a useful tool. I mean, I've executed hundreds of billions, so I can assure you, if you know what you're doing, they can be very useful hedging tools. This is the most simple example you could possibly imagine. You've got a customer. I called them an SME because in the case of Ulster Bank, they were SMEs rather than consumers or large corporations, but it could be a company, it could be a government, it could be a large corporate. And again, this is a simple example. I've stylized it to keep the numbers simple. And we imagine they've got a loan, a 5-year loan, at which they were originally borrowing on a floating basis. And again, I'm using old language, 3-month LIBOR plus 3%, because LIBOR was the key benchmark in those days. Nowadays, if we were to do it, we'd use different words. We'd call it SONIA, but it's the same. It's a floating rate, 3-month LIBOR plus 3%. And again, in this example, the customer decides they suddenly want to fix their loan. So in fixing a loan, and if you're paying fixed, which is what you would do if you wanted to, fix your loan, you would pay a fixed rate that is priced off the market, and you would receive the 3-month LIBOR. And I hope you can see from this picture that you now don't care what happens to 3-month LIBOR, because if 3-month LIBOR goes up, you receive more on the swap, but you pay exactly the same thing away on the loan. So you don't care whether LIBOR goes up or down if you fixed your payments. All you've got left is the margin on the loan of 3% and the fixed payment of 5%, which 3 plus 5 equals 8. So you effectively locked in your overall fixed cost of 8. And I've broken that down by the quarterly payments, because one of them is 3 monthly and one of them 6 monthly. So you would pay out net 0.75, 3.25, 0.75, 3.25 throughout the year. So that's your cost, 8%. You've used a swap, you fixed your cost. But now let's make it just one step more complicated. You weren't very sophisticated. You didn't have a Bloomberg terminal. You couldn't police the bank who provided the swap to you. So you suddenly find out years later that actually, although you were quoted 5%, the market rate at that time was 4.5%. Ah, that's strange, isn't it? Why didn't I get the market rate? Why did I? Well, because you didn't know what you were doing. The bank took advantage of you, and essentially that's what's happened big time in all of these structures. The bank has added a hidden margin effectively to the derivative, and you can see this is going. Later on in this slide, I'll show you exactly how much that means in pounds, shilling, and pence. But in simple terms, if we make 50 basis points for 5 years, and then you discount it back for allowing for the market rates, which you discount back, that is equivalent to me giving you 2.2% up front. That's quite a large sum of money, actually, particularly if the size of the loan is quite large. And that means on day one, the customer is out of the money on day one. The customer has made a loss on day one. And very simply, if you cut through all of this crap on derivatives and some of the fixed rates, loan sales and stuff like that, the whole motivation for all of such sales was this upfront taking of profits. Now, you can at least argue, if you've sold a genuine derivative, that is the proper accounting, and and if the customer was knowing, you might actually argue that's not unreasonable for the bank to make some money. But in most cases, the customer was completely unknowing and the bank took an excessive profit. And in the example of Ulster and some of the others, there was no legal basis for them to do it in the first place, and we'll come to that in a minute or two. But the motivation for all of these in these derivatives was essentially to take upfront profit. So again, setting just as background, obviously I've used the words out of the money, then the bank is in the money. Probably the first important term to understand when dealing with derivatives is the term fair value. Fair value is an accounting word and literally is nothing more than how much is the value of that contract worth today if I ripped it up today, if I terminated it today. It's the fair value. But the good news for the bank is that fair value goes straight through my P&L. That goes straight to my capital base. So if I can get you to pay me a hidden margin on a derivative, I get all of that profit today, first day of doing that transaction. That makes the bank quite a lot wealthier and allows them to lend more money. If I'd made that same margin on a loan, I would have to wait 5 years to get that money. So again, can you see that it's fair value accounting brings everything forward to today and is why the banks were desperate to use derivatives to get fair value accounting, to get the profits into their books today. So that's that's the driver for using derivatives. The next fact I really wanted to get across is, but a bank has to model counterparty credit risk. The language that the regulators use for this has changed slightly over time. If you were to look at anything written since 2013, the correct language is something called potential future exposure. And as I quote here, I've actually quoted, this is one of the single most important pieces of European legislation ever done. This is the CRR, Capital Requirements Regulation. Basically, that sets the rules for banks and their capital requirements for all banks in Europe, and still for the banks in the UK, because we have literally just copied it word for word into UK law. So if you were to see the UK version, it would still be Article 278. So it's exactly the same words, exactly the same numbering, but it's now UK law as opposed to European law. So the banks have to have this thing managed. The big banks all have sophisticated internal models now. They which I can't really demonstrate to you because I would have to open it up and show you that all the parameters they use. But the smaller banks are allowed to use other methods, which are simpler, formulaic methods. And so even today, the original exposure method is quite simple. You take the notional of the swap. So say the notional was 10 million. You multiply it by 0.5%, because 0.5% is what relates to interest rates. If it was gold, it'd be higher. If it was equities, it'd be higher again. You then multiply it by the number of residual years. So if there's 5 years to go, you multiply it by 5. You add the current fair value, i.e. how much the derivative is in the money. And then lastly, you have this magical factor. You multiply the total by 1.4. So that is the rule set that applies today. If you went back to 2007 and 8, which is the main period we were talking, there was a similar but slightly simpler and significantly less onerous rule set in place. So regulation existed. It wasn't called CRR, it wasn't European law. It was actually UK. It was banking rules. We didn't really use law in those days, but this BICPRU was the rule book, and Chapter 13 was all about counterparty credit risk. But again, very, very important point, because most of these customers didn't know that they had this exposure, and certainly didn't know that their security was being used against this exposure. The important point I want to make is this whole potential future exposure is given exactly the same credit risk weighting as the loan, okay? So if anybody ever says to you, this isn't a hard credit, they are talking complete and utter tripe, okay? Because a potential future exposure is exactly the same as a loan or a drawn overdraft. It is a credit exposure of the bank. It has the same risk weighting as the underlying loan, assuming that you're relying on the same security. If suddenly you had a different security source, then the rating could be changed. And then banks will tend to have a simplified version on their credit systems, because most of them have quite antiquated credit systems. So they might not actually have the PFE marked on their system as the credit limit. They will probably have a simple credit limit that is slightly bigger, or maybe a bit bigger than the PFE, because the PFE varies from day to day, because the fair value varies from day to day, the PFE varies from day to day, but the credit line is probably moved manually by the bank. And of course, that's what happened in 2007, 2008. Interest rates, well, particularly where you get to the latter part of 2008, isn't it? After Lehman's went down, the latter part of 2008, interest rates began to move down very quickly. And so suddenly these fair values shot up. And so the potential future exposures shot up. And so the banks were marking bigger and bigger credit lines against their customers. Okay, so that's hopefully, I hope I've been clear, but we'll carry on. I thought I'd use some numbers just to illustrate that everything in banking can be turned into numbers, And of course, it's numbers that really matter. So again, just going back to the stylized example I had on the first slide, 5-year swap, hidden margin of 50 basis point. I've added this other fact, 10 million notional, it could be a million, it doesn't matter, I've chosen 10 million. What we now, what I can prove to you just with a calculator is the fair value on day one to the bank from that 10 million notional swap is 221,655. I told you 2.22 because I was rounding it. I didn't round for these numbers. I did them to the nearest pound. 221,655. That's a lot of money that the bank has made from that derivative sale by adding 50 basis point to it for 5 years. And of course, one of the real truths is for many of these facilities, you'll see that the bank sometimes actually did derivatives that were longer than necessary. I've seen this for fixed rate loans as well as derivatives where the bank effectively sold them a 10-year or a 20-year derivative when actually probably the customer might have been happy with a 3 or a 5. And the reason they did it is because clearly, if you think about 50 basis points, if you've got 20 years of 50 basis points, you've got 3 to 4 times as much income up front. And it's all about maximizing the upfront profit. But now let's look at interest rates coming down. And this isn't too dramatic. This is rate. We talked about the 5-year market rate was 4.5. Here I've made it 1 year later. The 4-year market rate is now just 3%. So this is a move down, but it's not too dramatic a move. No, the actual move in 2008 was much bigger and much quicker, but I just wanted to illustrate it. And the fair value has gone from 221,000 to 748,000. And remember, this is the amount the customer would have to pay if the swap is torn up or cancelled that day. That doesn't get harder than that, does it? If you've got to write a check out to the bank for 748,000, that's a really hard exposure. Now, I've calculated the potential future exposure on the current method and the old method, and the numbers are quite different. So today, using the OEM method, the potential future exposure for that same fair value on that same derivative would be a whopping 1328, 1.3 million. And that's because the regulators have tightened up the regulatory requirements. They've decided banks need to hold more capital against this exposure because they actually realized the 0.5% they had wasn't enough, because they used to use 0.5% for the first 5 years, i.e. you could have a 4-year and it would still only be half. Now they use 0.5% per annum. So you can begin to see that they've tightened, they've begun to rack it up, the exposure. But the BIP through 13 rules would have calculated the exposure at 798, which is exactly £50,000 more. So which is nothing more than 0.5% over the 10 million. So it's just £50,000 more. And perhaps the bank might have had a credit limit marked on file of say 900,000. The honest truth is, if you were dealing with one of the really biggest banks, the number could have been slightly bigger than that because they had internal models. Their internal models probably did calculate a slightly bigger number than the 798 that BIP through 13 gave. But I hope, but the really important point here is that the exposure value, the potential future exposure, is a hard credit exposure. The bank has to report that to the regulator and has to calculate a credit risk weighted asset and has to hold capital against it. So the bank is very aware. This is not just an internal arbitrary credit mechanism that some people have tried to say. It's not at all like that. Now, I think one subtle point is, I think in most cases, most banks would use the credit limit in their pro forma LTV calculations rather than the exposure value. I think it's possible that a subset of banks might use the exposure value, i.e. update it with the current exposure as opposed to the limit, but it would vary. But I think in most cases, because their systems are not very good, the credit guys, the relationship guys would have no sight of this exposure value. They would simply be using the credit limit in working out their LTV calculations. It would be relatively rare, I think, where actually the actual daily, and bear in mind this exposure value varies every day, so that's another problem with it, because it could be bigger tomorrow. and you're doing a calculation. So on the whole, I think most banks would use the credit limit in their pro forma LTV calculations. So I've given you a little bit of language. That's fair value accounting. That really tells you how much you owe if it's ripped up. Potential future exposure is actually telling you how much the bank has to look at as its hard credit exposure and how much capital it has to hold against that exposure. And credit limit is a number at least as big as the potential future exposure. So very briefly then, just because I didn't want to repeat the same slides we did before. So what are the lessons from Ulster Bank? And what, to be frank, one or two other banks that have come my way. For Ulster Bank, it was clearly the hidden margin was the main motivation. They did it worse than others because they were so greedy. They booked the liabilities against their customers. And the reason they did that was they wanted to book the asset in their P&L, when of course actually the customer never even needed a derivative because the customer had a fixed rate loan. The customer didn't need the derivative, so it was completely fraudulent to book liabilities against the customers and to tell them they had swaps when they didn't need the swap. It was the bank that needed the swap. We've actually identified for some other banks an identical motive, i.e. taking upfront profit, which isn't quite as gross as the Ulster Bank approach, but is still a clear abuse of IAS 39 hedge accounting. What they've done is they've loaded the internal swap. So they've got the internal swap. They haven't tried to tell the customer they've got the swap like Ulster Bank did, but they've loaded the internal swap. But then they've said, haha, having loaded that internal swap, we'll say that's the hedged rate in the fixed rate loan. And what that allows them to do is to say, oh, on day one, I've made a profit on that fixed rate loan, i.e. I've made a day one profit from writing a loan. Well, the first basic rule of accounting is the day you write something, it should be done at market value, and there shouldn't be a day one profit, if you see what I mean. So they've effectively, any sensible auditor would have picked that up, but they clearly have done it. I've explained, I hope, that the potential future exposure, as it's now caused, comprise both the current fair value and an amount for future value volatility. It's a mandatory regulatory requirement. It generates this credit risk weighted asset. These rules have certainly been in place since 1st of January 2007, sorry, when Basel II started in the UK. Because if you go back to the PRA and you go back and you just, one of the good things about the UK is you can put in the FCA handbook. You can put in the date you're interested in. You can see the current version, but you can put older dates in. So if you put in a date, say in 2007 and 2008, you'll see that BitPru 13 was applying since the 1st of January 2007, and then you can see the precise regulation that applied. And so to me, and this is the thing that probably gets me most angry. I'm angry that Ulster did what they did. I'm angry that RBS have sort of tried to cover it all up. But I'm probably more angry with the regulators and people because, if they don't take their job and do this properly, then, what chance has anybody got, and it's utterly incomprehensible to me that courts or SWIFT should not have considered these assets and contingent assets as hard credit exposures. The prudential regulations certainly do. So as I say, in the case of Ulster Bank, because of these fraudulent internal swaps, and in the case of some other banks where they've actually booked an internal swap, but they've still marked an additional credit line. Again, there is no contract. If the bank has got this internal swap, on what basis are you adding a credit line against the customer? In fact, you told the customer in the first place that they should take a fixed rate loan to actually reduce their credit risk. You said to them, getting a fixed rate loan would reduce your credit risk because it would reduce your exposure to rising interest rates. And then, unknown to the customer in most cases, they mark a credit line against them. There's no legal basis for such credit lines. So as in the Ulster case, and the customer should never have been, it wasn't a counterparty to any proper contract. So these credit lines are fraudulent. They were then used by the banks in an abusive manner, in that they then use these in their LTV calculations, and that led to the move them into administration and the rest of the saga that many of us know. And yet it's incredulous to think that the FCA in the UK has taken absolutely no action at all against any of these cohorts of, whether it be Ulster Bank, whether it be certain other banks, whether they're for sophisticated or unsophisticated customers. And they do have the powers. This isn't mis-selling. This is actually fraud. You can't just make up liabilities. You can't just make up credit lines. There has to be a legal contract, even if it's they haven't even gone to the case of actually mis-selling something. They've just tried to tell the customer they got something they haven't. To me, that's fraud. And then because it's actually led to customer detriment, prolonged customer detriment, and in some cases horrific outcomes, and yet the regulator's done nothing. So yeah, that's my presentation. So hopefully some of you found that interesting and maybe cleared a few points, because many people have perhaps haven't understood all the features of a derivative, if you know what I mean. Yeah.
Ian, thank you so much.
Okay.
Not only is your presentation very clear, it's coming from somebody with tremendous credibility, given your background. The perspective that you have is one that we really, really respect. And as you know, it's a perspective that is impossible for the authorities to ignore, despite their best efforts to do so. Folks, can we do two things? Can we thank Ian whilst also welcoming Steve Middleton? We're going to go from Ian to Steve, then to Cormac, and then we'll be opening up to Q&A. So Steve, thank you very much indeed for coming on. And Ian, that was brilliant. Thanks so much for preparing it. Thanks, Ian. Thank you very much. Mr. Middleton, over to you, sir.
Yeah, Ian, thanks for that very technical explanation. Very, very, very useful. And I would suggest anyone who's had a swap keeps those slides and studies them carefully, because you will have found that on 90% of occasions, you would have been misinformed by your lawyers or barrister about how these liabilities work. And I'd like to say that I'm incorrect about that, but unfortunately, I don't believe I am. Now, I've just got to get, as Ian said, get this bit right, Andy, which is where I do my share screen, which is where I always panic as well. So can I just make sure?
So if you do it in this order, you've done it. You're more competent than you realise, Steve. Good man.
So I've got to get onto slideshow.
Yeah, just click on the play from start and you'll be fine. The top left one from beginning. There we go.
Yeah. Okay, so we're somewhere near.
Nice and colourful too.
Right, so margin credit, 10 years of lies. That may sound a little bit dramatic, but unfortunately it's not. It's how the banks and the FCA have covered up these swap credit lines. So what Ian has just explained very, very succinctly are real liabilities. And they're real liabilities that damaged people's ability to borrow, they damaged their credit rating, and they damaged their loan-to-value ratios. That is the thing that they've been keeping hidden over the years. And how have they done this? This is where I'm now trying to go to the next slide, Andy, and it's not moving forward.
If you click on the slide, it will normally do it for you. Just click on the slide. There we go.
Right, so what have the legal experts said? So there's a court case I've discussed before, which was Perks v RBS, which was a swap court case. And it was an interesting one because, again, as I've mentioned in previous events, for the first time, a GRG director was questioned carefully on this swap contingent liabilities or credit lines. These liabilities that are added to the customer's credit files when they take a swap out, but they're not disclosed to the customer. And for the first time, the director, who was a chartered accountant and very experienced GRG director, admitted that the debt was a real debt. This credit facility in the background, undisclosed to the client, was a real debt, real liability, and that could break the loan-to-value covenant. So if somebody had, say, £1 million factory and a £600,000 loan and a 70% loan to value, in theory, they should not go above 700,000 liability against that security. And he admitted that if the credit risk went up on the swaps, which would happen when interest rates dropped, then that could breach the loan to value. And what happened at the end of that trial, Paul Sinclair, KC, acting for the bank, got up and in his closing statement said, referring to Neil Graham, he did suggest, I think, that the contingent obligation could push a connection over a loan to value ratio covenant. That is wrong in our submission. Now, bearing in mind, Neil Graham had provided that testimony under oath in a witness box, and Paul Sinclair does not suggest who ours is when he says our submission. He just says that he's been informed, and he says he just got that wrong. So we don't accept that the CLU is another word, credit line utilisation, that people use around this credit line. So he says we don't accept it had the impact that my learned friend suggests. We don't accept there's a duty on the bank to volunteer information about the CLU. So that is a recent court case where the barrister is going out and on hearsay, overturning witness testimony and saying this credit risk around the swap is not real. What did Judge Jacobs do? Well, Jacobs followed what was said by Sinclair. He even quoted Sinclair's words, that Graham had been asked on the hoof and he didn't really understand. And he went on to say there is no evidence that the contingent obligation, which ultimately is an estimate of the near worst case risk to the bank at a given time, creates any such obligation. That was absolutely untrue, absolutely false. There was hundreds of credit documents that were disclosed and raised in the court case that proved that this credit risk was real. He said there is no evidence that it has any impact on the customer's ability to borrow under terms that have been agreed. That again was completely false. There was evidence disclosed that as the credit risk on the swap went up, the customer was forced to reduce his overdraft at the same time. And he said there is no evidence that the contingent obligation has or can have the effect of putting the partnership in breach of its loan to value agreement. That again was completely false. There were credit documents disclosed that showed them calculating the loan to value at 79% when 75% was the acceptable limit, and that included the credit line exposure. They even commented that without the credit line risk, he was under the loan to value ratio. All of that was disclosed to the judge, and yet he came up with this in his judgment. What happened then when John Swift did his review of the IRHP review, his lessons learned review? So Mr. Swift KC, as Ian rightly said, was paid £7 to £8 million to produce this report that he took almost 2 years doing. And he was given substantial evidence by myself and certainly Paul Carlier and others about this issue in relation to swap credit lines, these undisclosed credit risks. He came up with these statements. The question of contingent liability was brought to the FCA's attention late in the process and only properly surfaced during the implementation of the scheme. Well, the rules relating to disclosure of margin credit were actually drafted and put out with FSMA in 2001 and then updated in 2007 following MiFID. So how can he possibly suggest, bearing in mind, as Ian said, that under BIPRU 13, the accounting for these credit risks was the responsibility of the regulator and the reporting was done to the regulator? How could the FCA only have become aware of contingent liabilities as the review was underway in 2013? It's ludicrous. He also went on to say that this credit line risk was not covered under FSMA, nor the principles and rules made under it, and it was not addressed in the sales standards. Well, the interest rate hedging product review did not address this issue in the sales standards, which I and others have criticised both the banks and the FCA for, and that was done intentionally because they were hiding the fraud around this margin credit. The bottom line is, however, again, what he says is entirely false, as I'll go on to show you. This was all in the rules, both from 2001 and again rewritten in 2007. He went on to say, moreover, in practice, the breadth of the sales standards related to the disclosure of break costs would often have an equivalent effect, at least in establishing breach. So what he's actually saying is, if people had not disclosed break costs on swaps, and the fact that they've got this wrong, that covered any other type of breach in not disclosing risk. Well, as I'll go on to show you, that's completely ridiculous because the break cost, as Ian has explained, is a lower risk than the actual credit risk. He then went on to say in his report, the legal and regulatory background meant there could have been no reasonable expectation on behalf of customers for such a requirement to appear in sales standards. Now, quite miraculously, Mr. Swift KC quoted legal cases from 2018 and 2020 and judgments as a basis for not having these issues in the sales standards when the sales standards were drafted in 2012. So absent a crystal ball, I'm not quite sure really how Mr. Swift thought he'd actually undertaken due diligence on these matters before producing such drivel in his report. So Swift said there are no rules around this. It's not in the rules, it's not in FSMA. If we look at the pre-MiFID rules, this is prior to November 2007, there is a restriction on lending to private customers. So that's your smaller customer, your retail customer, an SME. And it says that a firm, so imagine this is your bank, must not lend money or grant credit to a private customer in the course of or with its designated investment business. Well, that's in relation to derivatives again, unless the private customer has given his prior written consent to both the maximum amount of the loan or the credit and the amount or basis of any interest or fees. So there you are, those are the rules. Prior to 07, if you were going to provide credit for a product like a swap, then you had to have a written consent, not a terms of business signed, but a written consent separately that the client knew about this, would accept that risk, and he knew the full extent of that risk. Post MiFID, which is November 07 on, in relation to providing descriptions on investments, the rules in COBS 14.3.2 say, yeah, you've got to provide a client with a general description of the nature and risks of designated investments, taking into account their knowledge and their experience, and the description must explain the nature and risks in sufficient detail to enable the client to take investment decisions on an informed basis. I would suggest that being informed means if you're going to buy a £10 million or take a £10 million loan and buy a 10 million swap at the same time, and that has an immediate additional risk of 220,000, that may go up to over £1 million within the next couple of years, that is a substantial risk and something you should have been informed about. And it goes on to say that you must explain that to an investor that they might assume additional financial commitments and other additional obligations, including contingent liabilities. Now, they're the things that John Swift said were not included in the rules. And there it is, COBS 14.3.2. And that any margin requirements or other similar obligation has to be disclosed. So the idea that these issues do not need to be disclosed or these additional risks is absolutely false. And it's shocking, as Ian said, that 10 years after the review into this mis-selling, the general perception out there amongst the judiciary, and in theory, many of the expert lawyers and barristers, is that you don't have to disclose these risks. Completely against what the rules say and what the accounting rules say you must do, the very same accounting rules monitored and put in place by the regulator. So what did the FCA say about how the review dealt with these margin credit risks? Well, David D'Souza, who was a well-known figure in the IRHP review and one of the lead supervisors, in an email to me confirmed, he said, the IRHP review does, of course, consider whether the bank sufficiently explained to the customers the risks of potential future (brackets contingent liabilities). So effectively, Mr. D'Souza, on behalf of the FCA, was saying, during the IRHP review, these additional credit risks were considered as part of the process. However, I hold internal records from KPMG, called the Rosetta files, where they did a confidential assessment of customers' files. And what they admitted in those files are the setting of any contingent liability is a credit risk function carried out as part of the operational process. The process is not related to the sales standards agreed with the FCA in respect to the past review of IRHPs. So in other words, we are not looking at this. That's an internal issue, and we have agreed with the FCA that we will not be looking at this additional credit risk of contingent liabilities. So why did the FCA lie about it? And I will get back shortly to why this is highly relevant to the Ulster Bank issue. What they've done for years, the FCA and the banks have relied on weasel words. And by that, I'm doing basically putting forward or changing their wording around these risks to suit themselves and avoid telling the truth. So they've relied continually on this contingent liability or CLU wording in both the review and subsequently in court cases, to suggest that any additional credit risks with swaps, or if it was related to fixed rate loans, is an internal risk for the bank only. You don't need to know about it. And what they haven't done is disclose the fact that although there is an internal liability, that liability is passed directly on to the SME or the customer by an equal or higher obligation on their credit file. So that means if there is, let's say, a £1 million credit risk on a swap at any one time, they would mark a credit line at, say, 1.1 or 1.2 million to cover that. That is the level of debt, classed as debt on the customer's credit files and recorded as such. That is the level of debt that will be taken into account when considering your security risks and your loan to value, despite all of the rubbish said by Mr. Sinclair and repeated by Judge Jacobs. So internal emails on the Parks case, quoting the fact that the CLU, or contingent liability, is a dynamic number which represents where the bank believes the mark-to-market value could potentially move over the term of the trade. That mark-to-market value is more or less the fair value Ian was talking about, the cost to get out of the deal. What they actually instruct the bank manager to do, and this was the bank manager putting these credit risks in place, they say, we strongly recommend you build in a 15 to 20% fluctuation when requesting your limit, as this avoids the need to revert to credit for increases. So because these risks changed on a daily basis, they're saying, well, look, if the risk is £1 million, don't just mark 1 million, because if it goes up slightly the next day, we might have to come back to you and say, look, we need 1.1 or 1,050,000 now. So that's what the bank managers did. They, when a customer took out a loan with a swap or a fixed rate loan that had swap liability linked to it, or where they'd falsely accounted for it, as Ian has said, they would mark that credit facility against the customer, and that would be the customer's risk on the customer's file. Sorry, just 1 second. I'm trying to get it moved on. Just having a problem there, Andy, with the...
No problem. If you just click on the slide, it should work.
It's not. That's what's throwing me.
Always, if you try, if you find the page down key on your keyboard, but don't worry, there is a plan B. I can quickly get the slides up and share them for you. Okay, but just give it a go while I'm getting that organised.
Yeah, no, it's been working fine until now, and then it's just for some reason stopped.
And what? If you carry on talking, Steve, I'll get those slides ready for you in just about 2
Right.
minutes.
Okay.
Thank you.
Right. So if we can go on to the next slide when you're ready, Andy. I'm going to talk through how a credit line's applied for. So effectively, when you go to take out a loan or apply to take out a loan, and the bank tells you that you should have a swap in place because that will protect you on that loan, what they don't tell you is that the bank manager will know that there's going to be a substantial commission earned, as Ian showed earlier, from that deal, and they will actually apply for a credit line to cover that initial commission and cost, and partly to cover any potential future risk. So effectively, the bank manager, let's say if you're taking a loan out for £1 million on against a security of £2 million, and they're selling you a 10-year swap, that might have an initial starting credit facility of another £100,000. But rather than tell you about that additional liability, they apply directly to the credit team. The credit team will then approve that additional debt. Are you managing to get that up, Andy? And what will happen is you will believe you were £1 million, and the bank will know you were 1.1 million, but that is not explained to you. And what is not explained to you is that's based upon current rates. And because you are buying a fixed rate, if rates then decrease, that what will happen is the bank manager will keep going back to credit, and they will keep asking for further increases in that credit limit. So what they do at all times then is rely on your all monies charge. You've signed a charge that covers all monies, including existing loans, existing loan liabilities, and any potential contingent or undisclosed obligations. So they're not coming back to you and saying, look, do you realise you now owe 1.2 million or 1.3 million because rates have dropped? They're just going back to credit, getting further approvals, And what's happening to you is you're sinking deeper and deeper into risk against your loan to value covenant, but you don't know about it. Okay. So as Ian said, the credit line that's been added, or this additional credit risk, is a hard liability. So again, despite everything said by Paul Sinclair in that courtroom as hearsay, that is absolute rubbish. They always calculate the credit risk in its entirety against your loan to value. So what happened in 2008 and 9, people who had potentially smallish liabilities initially, rates started dropping, and the difference between, say, the 5.5% they might have fixed at initially and they then 3 to 1.5% created huge additional liabilities. And this is what sent the majority of customers into specialist support units like GRG. And I've quoted it before, but a whistleblower I took to see Sir Norman Lamb literally said to Sir Norman, every customer I send to GRG for a loan to value breach was because of the swap credit lines. We weren't allowed to tell the customer this was the cause. We would have to find another breach or say, get an undervaluation on their property to manufacture a security breach. That is what they've been hiding, because what they're trying to do with these products is they're trying to say your only real risk is if you break them. Now, that's true if, like Ian said, if you buy a fixed rate loan, as long as you pay your fix, that should be the only risk you take. However, with these products, you have or carry that additional credit risk. So your risk on a daily basis can be much, much higher than that break cost risk. So it's two entirely different risks. I mean, they do interact with each other, but the biggest risk is this undisclosed credit. And they've got away for 10 years by trying to say this is not relevant. But it's this undisclosed credit that put most customers, certainly in GRG and in Ulster Bank, into GRG and into insolvency. Can we go to the next slide, please, Andy? A simple explanation of kind of how this works. So I've done an example of a £2 million property, a 10-year loan of 1.2 million. So keeping it simple, that's 60% risk against the £2 million property. The loan has a 70% loan to value covenant. So that leads to, on the swap, an initial contingent liability, and I've modelled this on one of the cases I worked on, of a circa £60,000. So that's going to cover some credit, some commission that's taken out up front that's not disclosed to the customer, plus a little bit of additional cover on the exposure. So they have a credit line on this loan for £70,000. And if we go to the next slide then, please, Andy. Now that's in 2009 when rates are 5.5%. So you get to 2009 and by March 2009, rates have crashed to 0.5%. So the actual liability now, this contingent liability, this marked internal liability, and I'll say this is quite a high multiple, but it is based upon one of the cases I've worked on, has now gone up to £440,000. And that's covered by a credit line approaching £500,000. Now, what matters here is, if you look at the chart, this person has a 70% loan to value. Within 2 years of taking out this loan and attaching swap, they're now at 85% loan to value. That is the real credit risk to the customer and to the bank. So that is what would lead to these people being passed into GRG, except the bank manager would not tell them about the credit line. What he would normally do is put a valuation into their valuation system at a level that he knows would breach the loan to value. So in other words, he'll bring a valuer in and he will say, value the property at 1.4 million or something along those lines. The valuer will agree with that. Then he can manufacture a breach when in reality, the real breach was caused by the undisclosed credit line. Now, this is the bit, again, I keep saying, go back to the same thing. It's this damage that has been done to people with these swaps, with this undisclosed credit risk. That is the bit they've been hiding all these years. We can go to the next slide, please, Andy. Again, just proving that these are real exposures. This is a part of a credit file from an RBS customer. They had a 25-year loan. At this point in time, you can see that their loan at 5.2 million has a credit facility attached to 3.474 million. And the other facility attached there is a 20,000 overdraft. So when you look at the customer's actual exposure, their total exposure is 8.7 million. So the idea of suggesting that this credit line is not a real liability is absolute nonsense. In this case, this customer's property had been valued at 5.2 million at the outset of the loan. It was 100% lend, very specific type lend to a certain type of customer. But the property had gone up to, say, circa £7 million at the first time I came across the files. But on paper, they were underwater because of the credit limit. So if you go to the next slide, please, Andy. So keeping it simple, what is the bigger risk? If you go back to this example, they've got a 5.2 million loan. The property's worth 7 million in, let's say, 2015, 16, 5 or 6 years after they've taken the loan out. The loan at 5.2 million, their total exposure, now the reason I put it at 3.8 million is I have evidence in 2013, 14, it was at 3.8 million. It might have been higher previously. So they're being put under, this business has been put under tremendous pressure to sell this property or even maybe get forced into insolvency because their debt on the books, bank's books, is £9 million and the property value is only 7 million. So that is the actual real credit risk. The loan and the break costs, however, the actual break costs to get out of the deal is 1.9 million. And that's what ultimately happened with this customer. They had to sell the property to pay off £2 million break costs. But they couldn't have refinanced anywhere else because anywhere else they went would have to replace that additional 3.8 million liability. So they couldn't borrow money. The credit rating was, excuse the term, knackered. They were not going to be able to replace that finance. And this was a group of doctors, with NHS income, paying the income stream. So this was almost gilt-edged income stream, but the business was ruined because of this undisclosed credit risk. And this is the thing that's been dismissed as it has no effect on the customer. It's ludicrous. You want to go to the next one, please, Andy? Why was it done? Well, just a simple example of, and I've rounded these figures up, but these are some of the cases that I've worked on. Swap, 2.1 million swap, 5-year term, taken out in November 07, initial contingent liability 114. We have on file the liability, this credit risk going up to 188,000. It would have gone higher, but I can only work to the files I've got because the bank withholds a lot of the documents when you apply for the files. The commission on that sale was £32,000. Yeah, so that's a day one commission on that deal, on a 5-year deal, on not too big a loan. Look at the next one, 2 million loan over 10 years. Initial liability, so that's the credit risk not disclosed to the client, 267,000. So they think they borrowed 2 million, they've borrowed 2,267,000. That, when rates dropped, went up to 550,000. That's at the point where they're told they're at 92% loan to value and sent to GRG. The profit, day one profit on that sale was 47,000. Look at the next one, a bigger deal here, 11.5 million over 10 years. Initial contingent liability, 1 million. That goes up to, I suspect, higher than this, but we know at least over 3 million. The commission on that deal, day one commission or profit was £180,000 for the bank. Undisclosed. All of these commissions undisclosed. All of them being able to be paid out because they put credit lines against you that they haven't told you about to cover these profits. Look at the final one, 5.2 million. That's the same one I was talking about previously. The contingent liability started at 1.45. It would have gone above 3.8, but I've got evidence of it at 3.8. The actual commission on that sale, 25-year sale, to the bank was 335,000 on day one, undisclosed. So if you just move on to the next one. So in the courts.
If I may, Steve, forgive me, Steve, if I may, just want to cut in to make one quick point. Ladies and gentlemen, please imagine another column on the table we're looking at. So at the moment, the last column is the result. Imagine another column reflecting the human cost and suffering caused. And I'm stressing this point because sometimes people think of financial crime, economic crime, fraud, corruption as being victimless. It's not. You know, the carnage that was caused to people through precisely what Steve is explaining is grotesque, horrific, and you would not think that human beings could do this to each other. It is shocking beyond words. And that's why it is so incredibly important that we get this out there, that we ask the politicians to help, that we ask the media to help us expose it. Too much harm has been done to too many people for us to be comfortable just standing by rather than standing up. Now is the time to stand up and to push back and to fight back. Steve and all the other speakers tonight are doing an amazing job, Steve, please carry on. I'll switch the slide now. Thank you.
Well, just before you switch, Andy, sorry, if you go back, you can see again, that's what I put in that final column there. That's what happened on these cases. The first case lost all the businesses, lost all the properties. As we speak, they're trying to bankrupt that person. The second one, transferred to GRG, that to sell the property related to that swap. I was involved in that case. We managed to get a very good off the record settlement, but that was still after they had to sell the property they bought that loan with. Look at the next one, transferred to business support, business failed, property sold, business, everything went. Look at the next one, had to sell the property to exit swaps. That's a group of GPs having to sell their own surgery to a third party to get out of the swap because they couldn't even let existing partners retire because it would break the swap. They couldn't bring anybody new into the partnership because they wouldn't allow them to go into the swap, the bank. So that's the kind of damage done by these undisclosed credit risks that the courts tried to say mean nothing. That people, lawyers and expert barristers are turning around saying it's not relevant. It didn't matter. As long as you knew about the break cost, the rest didn't matter. Ludicrous. But yeah, if we can go to the next one, please, Andy. So why did bank managers do this? Why did they take part in this? Because it's been said in court cases time and time again that the bank manager didn't earn a commission and didn't get any bonus. Well, that's interesting because here's one from the Perks case. Angela's confirmed the deal has been done and her income was 32,000. Well, Angela's the treasury person. So that's 16k for us. Hooray. About the only good news I've had today. Half of that initial commission was getting paid to the bank managers. So this they're not incentivized, they're not receiving it. It's all, again, weasel words. What they've said is that the bank manager didn't get a commission or a bonus, but what they did is they received a notional value towards their target. So it was actually worth more than the 16,000 because it was their targets were weighted towards the profit areas of the bank. So 2 or 3 sales on these swap products could lead to a bank manager doubling their income and more within the year. You had bank managers earning, 80, 90,000 pound earners earning 200,000 pound plus for selling 2 or 3 swaps. That is a big incentive to anyone. Yeah. Go on to the next one, please, Andy. Now, this is why the Ulster Bank one is so important, because there is this clear fraud here. So you had people buying fixed rate loans with no requirement to have a swap. And yet the bank has told them they had a swap. They've put the credit risk against them for the swap. And when you got to 2012 and 13, when all of these businesses are failing or in GRG or at risk of insolvency, the bank then said, you can't go into the interest rate hedging review because you didn't have a swap. Yeah, so a massive lies and fraud around that Ulster Bank sales process. And that is why the Ulster one is so important, because in 2012, well, we know the bank would have known about this, and we're certain the FCA would have done. Had they investigated this, they would have had to disclose the real effects of the credit lines on swaps. He would have put such a focus on this that would have been exposed, and that would have led other people with actual swaps in the other banks to come to a realization again that there were hidden risks that had not been declared to them. It would have proven that there were extortionate commissions that again were being hidden from the customers. When you sell a swap, you are supposed to provide a confirmation telling people what the contingent liability is, and you're supposed to disclose any fees or commissions. None of these were disclosed, and the FCA have taken no action over that. It would have established foreseeability of losses. So within the IRHP review, people won back some of their monies with interest, sometimes all of the monies with interest. Hardly anyone won any consequential losses because the bank always argued it wasn't foreseeable that interest rates would drop and this would cause you damage. Well, I'm sorry, but if you've got undisclosed credit lines in place affecting your loan to value, or that can affect your loan to value, it's entirely foreseeable that selling that product and suggesting it's going to protect someone could lead to them having substantial losses. So again, had this Ulster Bank fraud been exposed back in 2012, people would have been able to see that they actually should have been due consequential losses as well through the IRHP review. And the big thing here, and what they've tried to avoid, it would have exposed the fact that tens of thousands of businesses were forced into GRG and insolvency because of an undisclosed credit risk that breached their loan-to-value covenants. Now, even when you didn't have a loan-to-value covenant on your loan, the bank had acceptable parameters. So you might have had nothing stipulated in your loan, but if the acceptable parameter in RBS in your area and your type of security was, say, 75%, once you went above 75%, they were looking at sending you to GRG. And I've seen that happen on numerous occasions. Now, the FCA regulate all of the above behaviours. So they can't say, this is nothing to do with us, this is a regulated area. All of those behaviours are regulated by the FCA. And what I'm saying is that the FCA not only failed to protect Ulster Bank SMEs, they have colluded with NatWest Group, as they're continuing to right now, to avoid paying billions in redress due to Irish SMEs. Now, I hope that's come across a bit more clearly than maybe it has done. I don't know. It's difficult to explain because the credit line issue sounds complicated, but all you have to think is there is an additional undisclosed risk that could end up being anywhere from 10 to 60 or 70% of your loan value without your knowledge. Now, how can you submit SMEs to that level of risk and then suggest that does not do them any damage and doesn't need to be considered? I think that's me done, Andy.
The only thing I'd like to add is that it's not just the FCA. The Central Bank of Ireland is also responsible, because the trading desk was in Dublin, and we know that customers in the Republic of Ireland were also given exactly the same product set and things. We've focused on the FCA because that's who we've met, but there is a Republic of Ireland dimension to this.
There's a bigger issue in the Republic of Ireland because there are more of the products, and they're not quite the same documentation, but they have the credit lines. So the same scam has been run in the Northern Ireland and in the Republic. The reason we're focusing on the FCA is because we have evidence of the fact that I can prove that the FCA were notified about this from 2012 onwards. I don't have that same proof for the central bank. And that's why we're focusing on the FCA in particular.
Well, also, it's the only place where restitution will come from is from NatWest, essentially. So, yeah.
In terms of an analogy, I'm trying to think about how to describe it in terms of an analogy. The idea that comes to mind, this may not be a very good one, is it's as if a car salesperson sells somebody a car. Built inside the car is a bomb that may or may not go off. And the customer who bought the car not only paid for the car, but also paid for the bomb. I mean, what a horrific way of thinking about it. Can we please put our hands together? Steve, I know how much the time and preparation that would have took. It's an absolutely first-class forensic explanation of what's been going on, as clear as it could possibly have been. I'm sure we're all very, very grateful, Steve. That was superb. Thank you very, very much. Thank you. We're going to go straight to Cormac. Just before Cormac starts speaking, I'm going to share my screen because I've only known about Cormac for a couple of weeks, I think it is. And Cormac and Tim Bush were involved in a session, a very important session in Ireland a while back. It's in Rose Conway Walsh's webpage, Bank Insolvency Masterclass. If you haven't already watched this, please make sure you do. Please make sure you do. I'll put a link to it in the chat. Steve, thank you very much indeed. Cormac, if you haven't already done so, please take yourself off mute and share with us your very, very valuable insights. Thank you, Cormac. Thank you.
Thank you, Andy. I just get the slides up here. Right, what I'm going to focus on is an additional possible claim you may have that's aside from the claim outlined by Ian Tyler and by Stephen. or Steve Middleton. This issue relates to anyone who has taken out a hedging contract where the words cost of funding appears, or if you've taken out a variable loan and you've spoken to the bank and the bank said, this isn't a variable loan, it's a cost of fund loan. There is an additional opportunity where you may be able to take action against the bank. That's presuming that you've already taken out the first two claims as outlined by Ian and Steve. So this goes into the area of company law, which I'll focus on. And then you'll see the link between company law and the bank's cost of funds. In very broad terms, if a bank is seen to have borrowed illegally by borrowing while they're in breach of company law, then they will more than likely have had to pay a higher cost for that. And the bank claims that they can pass on that cost of funds to the customer. Now they cannot. In my view, the clause is invalid for that simple reason. However, they have persisted, and this may give rise to an opportunity for you to take action against them. So the first question we have to ask is whether Ulster Bank or Royal Bank of Scotland have borrowed illegally. Imagine you're filling out a mortgage application form and you overstate the income and you receive borrowings because you have overstated the income. Then that is a fraud and you could end up going to prison because you have committed a fraud against the bank. However, when banks borrow off the central bank or when they borrow off other banks, that rule appears to be overlooked. They ignore it. The result is that when banks were borrowing money, they were paying a very high LIBOR rate. And this is one of the reasons why they were told to tell a lie about the LIBOR rates they were using. So let's start from the very beginning, the foundation stone of company law. Basically, in company law, there is the concept of prudence. And in a nutshell, that states that the bank is never allowed to overstate their assets or understate their liabilities. Now, I say knowingly overstate their assets or knowingly understate their liabilities. They can make mistakes, genuine mistakes, and sometimes circumstances go against them where they end up for a temporary situation having overvalued assets. But you cannot do so deliberately. So this is company law. If you're running a company and you raise money from shareholders or lenders, you cannot tell them lies as to your financial position. So that's the foundation stone of company law. Now, there is a body called the International Accounting Standards Board, and their job is, in theory, to help people, or rather to write accounting standards that banks can use. In reality, they have behaved like a lobby group with the aim of maximizing bankers' bonuses. Now, here they say publicly, and I just want you to focus on the big writing at the end, IFRSs did not cause the crisis. This is the banking crisis, of course. They do not remove judgment or override prudence. So that means that if you're following the IFRS accounting standards, you cannot overstate the value of your assets, you cannot create artificial profits, and you cannot hide your liabilities. In other words, you cannot commit a mortgage fraud. So that's the public statement of the IASB. Let's look at the private statement. Now, these are a number of IFRS papers that are circulated mainly to the big four accountancy firms. In theory, they're available to the general public, but they're often written in language that no one understands. And in this particular paper, they talk about prudence. And what they say in the paper, if we go to the very end first, from the staff paper, they say, explaining in the basis for conclusions on the revised conceptual framework that the notion of prudence cannot, and I emphasize cannot, be used by preparers to override the requirements of IFRS standards. Now, what that says in a nutshell is, if we put in a loophole and allow you to hide losses, you can ignore the law. The law says that you must apply prudence, but what the IFRS people say is you can only apply prudence if we say so, you don't have to. So banks have been quite willing to fund the IFRS. They've also received funding from the big four accountancy firms, and to cap it all, they've received a subsidy from the European Union. But they are behaving like a lobby group, and they are telling people not to apply the law. So there's enough evidence there to suggest deliberate deception. The legal problem is that we are the sufferer. Anyone who's borrowed money from the bank and who has to pay extortionate cost of fund rates are really the sufferers. But we can't take action against the IASB because they're not contractually bound to us. But certainly there is an element of collusion there that you need to be aware of. So let's move on. There is another outfit called the European Financial Regulatory Advisory Group, and they too have said in very complicated language that you can ignore prudence. And the way they've done that is, if you look at the very last line, not even the last sentence, the last line, it says the two meanings may be similar. So what has happened is the IFRS people have tried to abolish prudence. They've said publicly that we require prudence in the standards. The European Union has said to them, you must bring back prudence, it's against the law. And they've said, fine. So what they've done is they've introduced a second definition of prudence. And they've said, we'll abide by the second definition, we won't abide by the first one. Now, they haven't stated that to the EU, but that's the instruction they're giving to people. So they've redefined prudence as simply being cautious, whereas the real definition of prudence, which is inherent in case law, is that you must not hide losses. Now, somebody explained that to me as follows. If you go in and rob a bank, the bank suffer losses and they're obliged to disclose that to shareholders. If you go into a bank with a COVID mask, then you're being cautious when you're robbing the bank. And that comes in under the second definition of prudence. You're allowed to do that under IFRS. You're allowed to give yourself a huge bonus based on false profits as long as you're cautious in doing so. So that's how ridiculous the second definition is. The IFRS people say you can use the second definition of prudence, forget about the law, and under the second definition of prudence, you are allowed to hide losses. Now, this has come up in Ireland, and it has come up in the UK under various bank inquiries. The person below there is Patrick Honohan. He was a former governor of the Irish Central Bank. And about 10 years ago, traders in Anglo-Irish Bank boasted about how they were able to fool the regulators. And they said, we could bully the regulators into giving us money, we'll bully the central bank into giving us money, we're not going to tell them that we're insolvent, we'll just bully them into it. And they more or less exposed that they were breaking the law. And this guy, Patrick Honohan, if you look at the third paragraph there, he said, the paragraph says, in his first reaction to the publication of the tapes by the Irish Independent, Central Bank Governor Patrick Honohan said the regulator was examining whether Anglo-Irish Bank deliberately misrepresented the position of the bank when it sought taxpayers' support in 2008. So basically, he's trying to examine whether Anglo-Irish Bank, when they were filling out their effective mortgage application form, did they tell lies about how much trouble they were in? And clearly from that, he believes they did. The same applies to Ulster Bank, Royal Bank of Scotland, because Ian Fraser has given you details of the huge amounts of subsidy they received. He has also pointed out that Ulster Bank's balance sheet grew from about 9 billion to 54 billion. So really what the people in Ulster Bank were saying is, we don't have to tell our losses when we advance loans. We don't have to tell anyone about our losses when we advance loans. So therefore, our bonuses are really based on the volume of lending rather than when the lending is profitable. So they went ahead and did that. They borrowed, Ulster Bank borrowed huge amounts of money. They lent it out and they concealed how much losses they were making. Yet they went to the Bank of England and said, we're solvent, we're healthy, but we're having temporary liquidity difficulties. and therefore we need you to print more money and put it into our account. And Allied or Anglo-Irish Bank did the same. Lloyds Bank did the same. All of the banks did the same. I don't know if Tim is here, but he's produced a report which we'll make available to you, where he lists all the banks and he shows their true capital position against what they disclosed. So they were all committing a company law offence.
No, they weren't.
Now, what appears to have happened is that although a number of Anglo-Irish bank directors were brought to court and they were imprisoned, they were accused of defraud and false accounting, but the charges were significantly dropped. So instead of saying you engaged in fraudulent borrowing, what they simply focused on was that there were liquidity issues within Anglo-Irish Bank, and that's what the directors were sentenced on. The problem was unique to Anglo-Irish Bank, and the benefit of reducing, or rather of changing the charge sheet, was that none of the other banks would get into trouble. They offered the directors of Anglo as sacrificial lambs, but none of the other directors of the other banks got into trouble, for the simple reason that they changed the charge sheet. If they had done things properly, they would have said David Drum overstated the assets of the bank, overstated and understated the liabilities. It was heavily insolvent, yet it went to the central bank and asked for money, which it got. So that is a fraud. If he had been convicted of that, all of the other banks would have come tumbling down as well. When I say tumbling down, all the directors, a lot of the directors would have found themselves in prison. So we have a situation where the regulators and court officials are redrafting the offence so as to reduce the risk of too many directors finding themselves in prison. In Ireland, the IBRC Commission was set up to examine instances where directors were given preferential treatment, certain customers were given preferential treatment. And basically, these customers were able to borrow loans at preferential rates. And the Cregan Commission was set up to look into the capital losses that these influential customers made. And the way that they were able to get around this was IBRC defined a capital loss in accordance with the International Financial Reporting Standards. What they said was, we'll only give you details of these losses or these preferential loans if we have written them off in our accounts. And because the IASB, this is the International Accounting Standards Board, said you can ignore prudence and you don't have to reveal all the losses, the accountants were able to tell the IBRC Commission that we didn't give away loans on a preferential rate because we had not, this is the yellow writing at the end, we had not formally written off the loans during the relevant period. So they were giving loans to on preferential terms. They didn't reveal the losses, so therefore they argued that there was no preferential loans given. But had they complied with company law, as opposed to the International Financial Reporting Standards, they would have had to reveal the losses, and the IBRC Commission would have been a lot more effective. In the UK, we're going to look very briefly, I know that you're exhausted at this stage, but we're going to look very briefly at Lloyds Bank and Royal Bank of Scotland. Court papers in 2019, this is the Sharp versus Blank case. You may recall that Lloyds took over HBOS in 2008, and HBOS was a basket case. It was completely bankrupt, and when Lloyds took it over, it pushed Lloyds down to insolvency levels as well, or close to insolvency levels. So there's two loopholes that you need to be aware of. First of all, HBOS knew that it was conceding losses, yet it produced accounts that it was making profits because it exploited the loophole. We'll call that the overvaluation of assets loophole. So basically, HBOS told lies as to its financial position. And when Lloyds were taking over HBOS, this came out in the court papers as well, Lloyds said to HBOS, we want you to conceal your liabilities because we're allowed to do this under the accounting standards. And therefore, it looks as though you're more profitable than you are, and therefore we'll be able to tell our shareholders that we can take you over. So these are two important loopholes, the overvaluation of assets loophole and the concealment of liabilities loophole. They are broadly permitted under the accounting standards, at least there's a claim that they're permitted under the accounting standards. In reality, they're not permitted under company law, and company law prevails. So what I'll touch on, once I can show you that we have proof that Ulster Bank and all of these banks have been breaking the law, I'm going to touch on what the regulation and what the law says. Where it's not complicated by Brexit, which makes life a little bit easier, but the relevant legislation is EU Regulation 1725 of 2003. And basically, all banks in Ireland must comply with this regulation, even if domestic law says something different. In the UK, you were obliged to comply with it prior to Brexit. After Brexit, according to the accounting standards people in the UK, you're still, because they're keeping the rules in line with Europe, you're still obliged to comply with it. And the regulation 1725 of 2003, as we'll see in a few minutes, makes it very clear that you cannot hide losses, even if the accounting standards say so. Now, one important point to bear in mind is that we all have to worry about the statute of limitations. It's a 6-year period. The statute of limitations only occurs from the time that the fraud became public knowledge. And in very broad terms, it's a complicated area, but in very broad terms, we have to wait until the banks admit in their annual reports that they've committed a fraud. There might be suspicions outside the annual report that they've committed a fraud, but that won't count for the statute of limitations, because the UK's Financial Reporting Council has said that all this talk about the IASB, the International Accounting Board helping people to hide losses, is all false. So the IASB has even got a legal opinion to say that it's possible to hide losses. And that's a very, just goes to show you how bad things are. But as I'll go through the legal opinion very quickly with you, but just bear in mind that there's a difference between the accounting rules as devised by the IASB and company law rules. And under the IASB rules, you are allowed to hide losses and disclose your financial position incorrectly, and you're allowed to borrow on that basis. Under company law rules, you're not allowed to do that. Why is that relevant to you as a group? Well, if you have a variable loan with Ulster Bank, or you have a fixed rate swap, according to Ulster Bank, if we borrow illegally and we pay a higher charge, we're able to pass on that cost to you. And that is completely false. So to summarize then so far, it is illegal for banks to misrepresent deliberately their financial position, and it is a criminal offence to borrow money using accounts to portray a misleading financial position. If you lend money to an insolvent bank, you're not allowed to take that money back. So therefore, insolvent banks cannot borrow. They must disclose their correct financial position. And if they can't borrow, they can't pay interest, and therefore they cannot charge the cost of funds to you. Banks cannot pass on the cost of these illegal borrowings to their customers. Therefore, in addition to the flaws pointed out in the derivative contracts by Steve Middleton, namely the hidden margins and the potential future exposure, as you've just heard, there is a third flaw, and that is they cannot pass on the cost of funds. And if it's referenced in the derivative, then in my view, the entire derivative fails. They cannot impose it. And according to the statute of limitations, because there's a serious misrepresentation there, they basically have to unwind the contract despite the statute of limitations. Now, I'm just going to refer you to an article in the Financial Times to show you how bad it's got. They've used Anglo-Irish Bank as an example, but it applies to a lot of other banks. I'll go straight to the wording. And PwC's David Tynan was appointed by the Republic's government to assess the shareholder claims, and he has now concluded that no payments are due because in the depths of the financial crisis, Anglo was both cash flow and balance sheet insolvent. So that part is correct. Anglo was insolvent. However, if we go further down, John Hurley said Anglo could not have been insolvent at the time because a big accountancy firm had examined the books of Anglo some months later and didn't come to that view. Now, what's going on there is, if you're a shareholder in a bank and you want compensation, whether that's Ulster Bank or Anglo-Irish Bank, the bank will quite rightly tell you that that the bank was insolvent and you're not entitled to anything. However, if you are the central bank and you want your money back, so you're a central bank, you have lent money to Anglo or you've lent money to the Royal Bank of Scotland, then you're entitled to the money back because they produce accounts on a different basis. The correct basis is to use prudence, the proper definition. The incorrect basis is to use the IASB's definition of prudence. So you have two different definitions for the same set of accounts. Now, in a third world country, that would raise suspicions. You have a bank producing a set of accounts for 2008. One copy says it's solvent and one copy says it's insolvent. That cannot exist, but it does exist in the UK and Ireland because of this. I can only call it corruption.
No, that's unfair.
Now, if you are lodging claims, the first piece of information you will need is evidence that RBS used improper accounting. I won't go through this, it's small print, but basically it's evidence that prior to 2018, the bank was hiding losses. We don't have to worry about the quantity of losses they were hiding. We have evidence that the bank used accounting standards and hid losses. They used accounting policies to deliberately hide losses. And that is a potential criminal offence. And as we'll see, they won't be able to defend it. So if you have that information on an affidavit when they're suing you for your swap, you can say that they can't use cost of funds in that swap because what they're trying to do is borrow money illegally and pass on the cost of those borrowings to the customer. They're not allowed to do that. Lloyds has given the same information. Again, this gets a little bit technical, but I just want to assure you that it's there. So there are plenty. The banks admitted in 2018, when they changed accounting standards, that the previous accounting standard, known as IAS 39, as Ian Tyler referred to, is a flawed accounting standard in every respect. And they've been using that accounting standard to hide losses contrary to the law. So the evidence is there that they've done that. It's in the annual report and it should be acceptable to the courts. There's plenty more evidence there. I won't bother going into it, but just bear in mind that it's there. Now, I'm going to go on to second piece of evidence, and this relates to HBOS. When the Sharp versus Blank case went to court, HBOS, rather Lloyds, took over HBOS. They took over the assets and liabilities of HBOS, and the result was that Lloyds shareholders lost an awful lot of money. And this particular document came out in 2019. I think the last sentence is quite important. However, a 15 billion fair value reduction in HBOS's loan book was more than offset by the reduced value of HBOS's own debt in issue of 16 billion. So basically, HBOS was hiding loads of loans, but in this case, in the first year, they were hiding 15 billion in losses. So what they said was, well, that doesn't make a difference because we think the value of our liabilities is 16 billion lower than what it is. So we're due to pay back 300 billion. We'll reduce that down to 284 billion. And that meant that they created an artificial, and I emphasize artificial profit, to hide the losses in their loan book. Lloyds were aware of that. They said, we don't mind, take it over anyway. Lloyds were hoping that they could use the assets against Bank of England borrowings, and the Bank of England made it clear that they weren't too worried if the assets were overvalued when they lent money against them. So that is, without doubt, a fraud. There's no other way of looking at it. Basically, Lloyds said, we want to take over HBOS at any cost, and if we're going to lose 15 billion, we're going to take advantage of an accounting gimmick and make profits of artificial profits of 16 billion to bury the losses of 15 billion. And this is a comment from the judge. It should, however, be observed that this fair value adjustment was not permanent and would unwind over time, because unless the debt was bought at a discount, which it wasn't, the enlarged group would have to pay the debt back at face value. So if you write the debt from 400 billion down to 384 billion, you're going to create an artificial profit immediately, but that has to be paid back. So what you're really doing is burying a loss temporarily. You have to pay it back in the future. Now, I can guarantee you, if the judge had said that 20 years ago, both the bank and the auditors would, as far as possible, sue the judge, because he's making a very serious criminal allegation. He's saying that the bank is deliberately creating artificial profits in order to get this takeover through. However, the judge in this case appears to believe that the accounting standards permit it. They don't, but the judge appears to believe that. He would have had expert evidence from the Big Four stating that this was permissible under the accounting standards. But as we'll see in a few minutes, that's not the case. So again, I just want to emphasize why this is important to you. If you have borrowed money from Ulster Bank, or you've borrowed money from Lloyds Bank, and the term cost of funds is in your term sheet, then you can legitimately say to the bank, what do you mean by cost of funds? And they'll say our borrowing costs. And you can say to the bank, from 2007, you were misrepresenting your financial position. And therefore, even if you did borrow money, you were paying excessive interest rates. Are you going to pass on the cost of those illegal borrowings to us? Or more precisely, does the term cost of funds allow you to bury your heavy losses against us? And the answer would clearly be no. They cannot make profits from illegal earnings of that nature. And if that was proven, then it would be very easy to prove that the swaps were fraudulent as well. Because if I was advising somebody taking out a swap with Ulster Bank, I would say, okay, you're going to save on the cost of funds, but you have to pay a fixed rate. But this, because the cost of funds clause is flawed, the cost of funds you'd have to pay is close to zero anyway. And therefore, the swap is an outright fraud. It's forcing you to pay 5% per annum, whereas for 5 years or 10 years, whereas you wouldn't have to pay it. So if we go back to Ian Tyler's comment that there is a margin there of 0.5%, and over 5 years you lose 2.5%, we could take that argument a stage further and say the margin is effectively 5%. It's the entire fixed rate, and over 2.5 years, that is 22%. Sorry, over 5 years, it works out at 22% of the loan value. So to recap, Ulster Bank cannot pass on the cost of their own illegal borrowings to you, the customer. Now, I've given you the evidence that's in the annual report. What I'm going to focus on very briefly is the legal requirement. Unfortunately, it's fairly simple. I know it's getting a bit late, but I'll try and rush through this as quickly as possible. The legal requirement is as follows. All UK and European banks are required to state the following in their annual report. We report to you as to whether the statements comply with the Companies Act, particularly Article 4 of the IAS regulation. And Article 4 of the IAS regulation refers you to EU Regulation 1725 of 2003. So basically, you must comply with regulation. The auditors and the directors must comply with Regulation 1725 of 2003. Now, Regulation 1725 of 2003 is very, very, very specific. What it says is that financial statements shall present fairly the financial position, financial performance, and cash flow of an entity. Fair presentation requires the faithful representation of the effects of the transaction. And then it focuses on the framework. And it says that you must use the definitions and criteria of the framework. So emphasis on definition of the framework. And we're going to look at one of those definitions in the framework. Prudence is one of the definitions in the framework, and you cannot overstate the value of your assets nor understate the value of your liabilities. So if you're preparing an affidavit and you're saying that the cost of funds clause is invalid, you can use these two paragraphs to explain why it's invalid. And you can also use the information from the annual report to prove that they have actually used wrong accounting. So they've deliberately misrepresented their financial position. The misrepresentation was quite large. And what the bank is claiming is that even if we misrepresent our financial position, and even if we have to pay a huge amount of interest, we're going to pass that on to the customer through cost of funds. And the likelihood is that the judge will say, well, if you were allowed to do that, that's, the actual clause where you can pass on cost of funds is illegal. I think that's all I want to say for the moment. I don't want to bog you down with too much technical detail at this time of night, but just to summarize, look at your loan documentation and look at your hedging documentation. If the term cost of funds appears, it means that the bank can pass on the cost of their borrowing costs to you. If the question is, can the bank borrow illegally and pass on the cost of those illegal borrowings to you? The answer is definitely no. And therefore, the cost of, if they claim they can, the cost of funds clause is invalid. And if it is invalid, the derivative on which the cost of funds clause is based is also invalid, particularly as Ian and Steve pointed out, they would have been sold to you over the telephone, and they would have required you to make a quick yes or no answer without examining the details. So it's a third bow, if you like, apart from Steve Middleton's argument that the potential exposure could have forced you into bankruptcy, and Ian Tyler's argument that they were passing on margins, hidden margins to you by extending credit lines. So that's all I'd like to say at the moment. Thank you.
Cormac, thank you. That really was remarkably interesting. You've brought a whole new series of new ways of looking at the issue, and we're very, very grateful to you for that. Ladies and gentlemen, can I please invite you to put your hands together for Cormac and, of course, all the previous speakers as well. What I'm going to propose we do, folks, it's 12 minutes past 8. I think it's really worth our while having a proper Q&A and discussion, but let me manage it in this way. I propose we have a 5-minute break, go and get a cup of tea, stretch your legs, whatever. For those of you that want to come back and dive into a Q&A discussion, let's do that. For those of you that may want to be disappearing now, that's absolutely fine. So please, back in 5 for what I think is going to be a very interesting conversation. Okay, folks, it's coming up to 17 minutes past. So we've all had a chance to stretch our legs, perhaps grab a cup of tea, a bit of fresh air or whatever you've just been doing for the last 5 minutes or so. What we're going to do is open things right up. We've had some absolutely first-class input from Ian Fraser, from Steve Middleton, from Ian Tyler, from Cormac Butler. There are various other subject matter experts with us tonight. Nicholas Wilson's put his hand up first of all. Nicholas, please take a moment to introduce yourself and then share with us whatever you'd like to. Thanks, Nicholas.
Hi, thanks. Nicholas Wilson, I'm a whistleblower, blew the whistle on a massive HSBC fraud. Steve, you'll be pleased to know that I now get credit lines, hidden credit lines. It's taken me months, but thanks to your presentation. But I don't have a financial background. My background was the law. But I need to understand this for social media purposes, because I want to, this should be better known than it is. So I just got really just one question with 2 parts to it. Would the borrower have knowledge that the bank was using a swap or derivative to cover the loan? And the second part to that is, if they were a sophisticated borrower, would they have taken it out?
Do you want me to answer that, Andy?
Whoever.
So basically, sophisticated borrowers should have had advisors and may well have done hedges before. And at that level, they would then undertake an ISDA master agreement, which sets out the terms of the swap and the borrowing, and it sets out the credit agreements and the margin agreements and thresholds. So if you're going to undertake a swap, you should actually have spent, even at a lower level, thousands of pounds on a lawyer negotiating the terms of the swap and making sure you're contractually covered. But the majority of people,
I don't
about
think that's the question,
95%.
Steve. I don't think you're answering his question, Steve. I think
No.
Well, to an extent.
Ian, if you just let me finish, what I'm saying is 95% of the people who took these swaps out, Nick, had never did an instant master agreement, had never done a swap before, had no understanding about margin credit, knew nothing about these liabilities.
Okay, I get that. But if you'd paid the money for the lawyers and the advisors, would the bank then be able to con you if you were a sophisticated borrower?
No.
No, right. Okay, so that really answers my question. So most people didn't know it was going on, and it was a scam.
Sorry, I think, Nick, you need to be really clear. Were you talking about a fixed rate loan, or were you talking about a floating rate loan and you were
I'm actually picking up from when Steve spoke last time, so I'm really talking about a fixed rate loan. That's something I understand.
Yeah, which is, so to be clear, the answer to your question is there is no, you should not be involved with a derivative. If you've done a fixed rate loan, what the bank does is nothing to do with you. You have a fixed rate loan. That's what I thought you were asking.
That was made clear in the last session we had. That it was the customer thought they had a fixed rate loan, but the bank were doing these hidden credit margins behind.
Well, no, what the bank does is nothing, is entirely up to the bank. I mean, I can use, I mean, the reality is,
but the customer doesn't know. The customer,
they don't need to know, and it's nothing to do with the customer because they have no legal contract.
No, I understand that, but that's how the banks put them into liquidation.
No. Now that's where we're mixing things up.
No, we're crossing two lines there, Nick. With the fixed rate loans, keeping it simple, with the fixed rate loans, there should be no credit line attached.
Right.
There is on the Ulster Bank ones because the bank have committed a fraud. What they should have done is an internal hedge, taking that credit risk internally, but they've passed it on to the customer so they can take those commissions.
Correct.
Right. Okay.
I agree entirely with that.
It's a particular type of fraud, on Ulster Bank.
Okay. Thank you.
Okay, that looks like that was a very useful exchange of thoughts, and he clarified some bits and bobs. Who'd like to come in with a comment now or a question? Please just raise your hand. If we don't have anyone coming in, I'd be really keen to get Ian Tyler and Steve Middleton and Ian Fraser's thoughts on what Cormac was explaining, because a lot of that was pretty new to me. But we're going to go to Tamara first, then to Andy Candy, and then we'll get reflections on what Cormac explained from Ian Fraser and Steve. Tamara, if you can, please turn your camera on, take yourself off mute, and share with us what you're thinking. Thank you.
Hello, everyone. Thanks for inviting me today. It's been very insightful to hear from everyone. I have two sets of questions. One question is, as a non-sophisticated investor, what are the mechanics I could do to get an administrator to release the books of a company that is in administration that is a concern for serious crime and investigation, so that I can prove fraud or scam, have some sort of a proof, which I can then turn to my bank, the sending bank and the receiving bank, coincidentally being HSBC and Lloyds Bank, to basically get a process set up in place to ask the bank to refund the £85,000. That's one question. It's a practical question. The second question relates to mortgage securitization, I think, which is sort of relating to what has been latest commented on. Would like to understand. I had a chat with a chap called Paul van den Rome, who is leading, I believe, some initiative around this mortgage securitization in the UK. So where we are in the market with regards to the mortgage securitizations, is this something that we can realistically expect to potentially be rolled up to start inquiring from the lenders about these swap equities to get some returns from mortgages, fixed mortgages. Thank you for answering.
Okay, let's take the first one. Folks, who'd like to respond to the first question, which I think, if I understood it rightly, was how can you go about getting disclosure of the accounts, the books of the companies concerned, if I understood that correctly? Steve,
Yes, that's right.
yeah, do you want to jump in on that one first, Steve?
I would caveat saying the administration is being run by an administrator group that works in favor of the culprit on the courts.
Is it a limited company in administration?
Yes.
Okay, I'm not an expert on that area, but my experience would lead me to say that if there are losses attached to a fraud that's been suffered, then you should be able to put pressure on the administrator to get the documentation required, yeah, to for the benefit of the creditors. If that administrator won't get that information or refuses to look at it or act for it, you could challenge the impartiality of the administrator, but that's just based upon experience of people I know who've had those problems.
So was this an investment you were misled into? So that is the company a regulated? Was the company a regulated company?
Unregulated company, but secured by a Gibraltar-based Castle Trust Group, and
So it's unregulated,
but secured loan notes. Yeah.
Secured by what? By assets that they have.
Yes.
But because you mentioned the 85,000, that won't apply because there won't. If it's unregulated, there'll be no financial services guarantee or anything. It will, as you say, your only hope is that the security is worth what they say it is, and that when they administer the firm, there's a payout to the secured creditors.
Yes. So we already know through the administrator that there is no money in the administration, as it has been subject to be proved upon the scheme. It's a case of the High Street Group. Total volume £130 million, 1,500 investors involved.
Sorry, and are these investors across the whole of Europe or mainly in the UK or?
Mostly 80% UK, 20% abroad.
What's the name of the firm then?
High Street Group, GRP Limited.
I've not heard of them, but okay. Well, I mean, you're not
Gary Forrest.
You're not. I mean, you're not starting from a good place if it's not regulated, are you? Gosh. Is there a committee of you that have organised yourself as a creditors committee and things?
Yes, the creditor committee claims that they signed an NDA with the administrator, so they are not able to disclose any information, so they're effectively useless. And the administrators have been appointed on recommendation of the owner of the company by court, so they work there in his pocket and on the decision.
And is the administration being done in Gibraltar?
No, it's UK based here.
Oh,
it's a UK company.
It's a UK company. Sorry. Okay.
The suggestion, only from an insolvency point of view, if you're concerned about the conduct of the appointed insolvency practitioner, then I would strongly recommend you contact the Insolvency Service, which is part of the government department, business enterprise, or whatever it's now called. Whilst they may not directly regulate the particular individual, it may be one of the insolvency practitioner bodies, which is a self-regulating system. However, the Insolvency Service are concerned, as a general point, about the conduct of insolvencies by whoever's doing it. And if it's a kind of small-time insolvency practitioner or whatever, they tend to be more interested in that than going after the big boys. So I would try the Insolvency Service.
Okay.
Okay,
Thank you.
I do hope that was helpful. We're going to move on. We've got.
Sorry, my second question was relating to the mortgage securitization. If you can paraphrase on the situation of that, that would be great.
I have a suggestion. It's kind of outside the scope of this particular meeting. We've got some other things to get through. So if it's okay with you, we'll pop me an email about that. We have some contacts who are pretty much on the pulse regarding that, and I'll make a connection for you. Okay.
Okay, sounds great. Thank you. Thank you, everyone.
Thanks for your input and those thoughts. Thank you. Let's go to Andy Candy, and then we'll go to anybody else that wants to chip in. Andy.
Thanks, Andy. Thanks to all the speakers this evening. They've been absolutely outstanding presentations and really clear. And I've sat through quite a few now, and even I'm learning new stuff and slightly nuances on all the different bits. I'd like to throw a slight bit of a curveball in, just slightly related to my situation. Many years after the event, after receiving a tear up in the scheme, but no consequential losses, I was approached by HMRC, who opened an investigation alleging that I hadn't declared the full amount of redress that I'd received in the scheme from the bank. They had the amount of interest that I'd received on the direct redress, correct, but they had me down as receiving over twice the amount of direct redress. And when I asked I could prove obviously from the statements I'd received during the scheme that I'd got what had been entered into my accounts and accounted for properly by my accountants. However, HMRC wouldn't then release information as to where they'd got their data from in order to make such an accusation, which was very specific and very detailed in terms of the numbers. So I'm guessing it could have only come from the bank itself or their observation of the bank's balance sheet. And I just wondered if it may occur to any of you in terms of the accounting side, why that may have happened.
Andy, can I just ask on this? Did you pay tax on your redress?
No, because I was totally screwed on it, so I didn't end up paying anything on in terms of tax on the redress received, because it was all taxed in the year that you received it, rather than obviously as you made the payments out over term.
Yeah, but under 500,000, you really shouldn't have been paying tax on it anyway, and possibly even over that amount. There were tax concessions on it. That's why I'm just wondering why HMRC are taking any interest at all.
Well, they literally contacted me and said, we believe you've made a false entry in your account. We've got a record of you receiving £198,000 in redress from the bank, and we only see that you've entered around 110. And could you explain that? And obviously I could explain exactly what I'd got received and entered and had accounted for, but they wouldn't tell me where they'd got the extra money from. And I just wondered, hearing all this sort of nuances of how the banks are fiddling this accounting in the balance sheet, whether that's something that they've actually additionally reported incorrectly to the FSA or whoever else is involved, whether this is just another symptom of the fraud rolling out through their books, and maybe they are under investigation, I don't know, by HMRC for this sort of thing. I'm not the only person that's been contacted by HMRC about their returns, so but not
there's no obvious answer, Andy, because I mean, as you rightly say, the only people who would know that information are potentially would be HSBC, and I guess it's possible that Deloitte would know it because they were involved in the process, but I think it would be HSBC would have been the source of the information. And but I can't see why they would quote a bigger number, because ultimately they only get tax relief on what actually goes through their books, and they've got no vested interest in reducing their profits, really. You know,
it wouldn't be a manner of them hiding some of the false accounting in terms of allocation to customers. Well, you're right. If there's it's difficult to construct a fact pattern that would really give them an advantage. It is a bit weird. It is a bit weird though, isn't it? yeah, they were very specific, and I couldn't think why the bank would report me for something they knew was inaccurate. So it struck me that it was an investigation by HMRC into HSBC's declaration of redress awarded in the scheme. And therefore, was it symptomatic that they'd actually falsely accounted what they paid out in redress to customers? And that's what HMRC were checking on, and are probably doing something on the quiet to resolve that issue with them. I don't know.
Well, maybe. Interesting.
Okay, thank you, Andy. And let's hear from anybody else that wants to come on this. Anybody else? Oh, Alex Varley-Winter, then we'll go to Stephen Barker. Sorry, I didn't see your hand, Alex. So go for it.
Yeah, I can't seem to do the electronic hand raising thing. It must be my Zoom's not up to date or something. I was just going to ask, because Cormac Butler and Tim Bush gave evidence of a lot of what they were saying to Parliament in 2019 in Ireland, Did they feel that that evidence to senators had an impact? And if so, what kind of impact did it have?
The answer, it didn't have an impact. The central bank was asked to write to the committee and examine the evidence, as were a number of other banks. They wrote back to say that we're happy with our processes and we believe that we acted properly. So they didn't really address the complaint. They simply gave the standard reply that they must have farmed it out to some legal firm, and they said everything is okay because you're complying with the accounting standards. Tim Bush was responsible for a legal opinion asking whether the International Accounting Standards Board rules complied with the law. And they got back a legal opinion from the other side, so to speak. And the other side said that the IASB were incorrect to change the framework, because what the IASB, as I explained, said was we're either going to abolish prudence or we're going to invent a new definition of prudence. And the legal opinion they got back said that they're not allowed to take out prudence. There was a future of audit inquiry that took place around the same time, and the future of audit inquiry concluded that the Institute of Chartered Accountants gave illegal advice. The Institute of Chartered Accountants admitted that they gave illegal advice, but they said we were trying to get the law changed to bring the law into line with the accounting standards. A few attempts have been made to bring this up to court, but generally when we do, we find that we don't have at least I don't have complete control over the court process. And I find that the problem that I articulated has been changed so that they can answer the question. So there's quite a lot of powerful lobbying against what we're doing. But so far we haven't made progress. But having said that, I can give you the legal opinions confirming that the IASB were forced to backtrack on what they attempted to do in order to change the law.
Amazing. And I should mention that Alex has done a particularly good set of tweets about the work that you guys did. Alex, please do put again into the chat the link to that tweet series, that tweet trail that you did. Thank you.
Oh, sure, no problem. Thank you.
It's really good. For those of you that don't know, Alex is TTF's volunteer head of investigative, I can never say it, head of investigative journalism or reporting. She's a pro journalist. Thanks, Alex. Mr. Stephen Barker, your turn. Thank you.
Thank you. Well, actually, it's to Cormac. I did get the opportunity of seeing the YouTube session earlier today. Which was excellent, I have to say. Very straightforward answers and comprehensive answers. We don't seem to get people like that, like your good selves turning up at our Treasury Select Committee. We get, people who couldn't tell you yes or no about anything. The lady who was really quite impressive was Rose Conway.
That's right. Yeah. Yes. Yeah.
I mean, I don't know if she's still in politics, and
she is still in politics. Yeah.
We'll put the politics to one side. All right. Sinn Féin, I think she represents.
Right, yes.
We'll kind of put all that to one side, if I may. But I did think that as an individual, she asked some very straightforward questions of you. In fact, the pair of you, both you and Tim, were quite complimentary when she was asking the questions, and whether that was just flattery, I don't know. But nevertheless, it gave you an opportunity to give some really good answers. So, and the only thing I thought about all this, and I hadn't really appreciated the closeness, in a sense, over this whole sort of financial scandal between Ireland and the UK. I know we know through these sessions about Ulster Bank, but I hadn't appreciated that really you've had all the same issues over there. And I just wondered if at a political level, whether people like Rose Conway has any kind of channel of communication with UK politicians, or at least those UK politicians who have the same interest in the subject that she obviously does.
I know that Tim Bush, I think he's gone at this stage, but he has a number of contacts with UK politicians who are sympathetic to this issue, and I think that obviously he'd be quite happy for Rose Conway Walsh to be introduced to these people. There's no formal channel as of yet that I'm aware of.
No.
One thing you should be aware of is that Ireland is heavily dependent on the European Central Bank.
Yeah.
So all these loans to vulture funds wasn't done because the banks thought it would be profitable. It was done because the ECB told them to do it. And the ECB were aware as far back as 2004 that the IASB were, sorry, 2006 certainly, but there might be records going back further, that the IASB were going to hide losses. So the ECB are basically wedded to the issue. They don't want it exposed. And I think that many politicians in Ireland who are sympathetic would find that they have little support for that reason.
Okay. Thank you. Thank you.
Thank you. Okay, Steve Milton, I think your hand's up. Steve?
Yeah, I think one thing you've got to recognise over in Ireland, Stephen, and don't take this the wrong way, Cormac. When I found out what was going on in Northern Ireland and what happened, literally it's the Wild West over there, because the lawyers involved in many of the cases, or who were supposed to be involved, nearly all are on the bank's panels, and people have just not had. You know, I mean, Cormac and Tim probably are one of a band of very few professionals over there offering any type of support to victims. That there is nobody over there talks about the rules or COBs, and there's no understanding of it. It's quite shocking, you know, and the courts themselves are almost unaware of many of these regulations, and that's why it's, I think, so appalling what the FCA did, because it was even more abusive, because these people had the least protection of anybody in the United Kingdom when it came to trying to defend their homes and businesses.
Well, there's two things on that. When we try to employ barristers in Ireland to represent us in the courts, they are reluctant to do so, because if you're trying to survive as a barrister in Ireland and you turn your back to the financial sector, you might as well give up. The second thing is, at least I found that the media turned against us. We had a situation where a judge back in 2005 ruled that the journalists were trying to cover a case, and one particular barrister said, we'd like these journalists removed. This has to be done in private. And it was a breach of IAS 39, and I'm quite certain that the courts didn't want anyone to know what was going on. The particular newspaper was very miffed, so when I approached them about writing articles, they were only too happy to take it on, but they were certainly came under pressure from the International Accounting Standards Board, and they asked me to stop writing articles on finance matters. So in the courts, amongst the legal profession and the media, it's a complete blackout. They ask them about company law, and they'll more or less turn away or slam down the phone. They're just afraid to talk about it.
The only point I want to say is, obviously IAS only came into force within Europe and UK and Ireland on the 1st of January 2005. So before that, we had our own gap. The next thing I'd say is, of course, IAS actually applies to an awful lot of countries around the world. It's not just a European thing. It's used by Australia, Canada, and effectively, and loads of other countries. And of course, US GAAP, which is the only other major accounting standard, is very, very similar to IAS. There's a convergence project to make US GAAP and IAS as similar as possible. So the issues you talked about aren't just a UK Ireland thing. This is worldwide.
Yeah, I'll come to that point because it is important.
But I also do think that ultimately it's a very hard one to persuade people to, because accounting standards change over time. I mean, that's just the reality. You're right. IAS 39 was their first attempt. Then the regulators, in response to the financial crisis, said, we would like losses to be recognized earlier in the cycle. And so that's why IFRS 9 came out in 2014. But it's a different accounting standard, so you get a different answer. So that's
Well, just on those points. First of all, why is Ireland and England different from the rest of Europe? The rest of the Europe didn't have the same banking crisis that Ireland and England had.
oh, yes, they did. Yes, they
Well,
did.
not as bad as Ireland.
Well,
I mean, Ireland and England stood
Ireland
out.
probably had the worst because
Yeah.
Ireland nearly brought down the whole country. But absolutely, God, the Germans lost billions and billions.
No, I accept that they did lose, but for different reasons. But just on a very technical point, I won't bore you with this. Ireland and UK, through the Financial Reporting Council, were encouraged to apply IFRS 9 not only to the parent company but the subsidiaries. Whereas in Europe, they didn't avail of that option, which means that the subsidiaries produced proper accounts, and when they consolidated under IFRS, which meant it was more difficult for them. I'm not suggesting they didn't hide losses, but it was more difficult for them to hide losses. Whereas in Ireland and England, IFRS was applied at a subsidiary level as well as a head office level, which meant that the subsidiary accounts were wrong and therefore the head office accounts were wrong. And the process was used in America as well. So the incurred loss model, or the equivalent of IAS 39, was used in America. And this explains why there was $1 trillion in losses after banks had paid out $1 billion in bonuses. But I think IAS 39 hit Ireland and England much harder than the rest of Europe. America got hit.
I accept that France, for example, didn't apply IAS 39 as strictly as some other countries, but
yeah, and so Spain as well.
They hid the losses more.
Yeah.
But so I'm not sure I really accept that. I think other countries had significant losses, actually. In fact,
they did have losses, but these would have arisen through derivatives and securitizations, which were not captured as well.
Look at the Italian banking market. Italy, even today, still has bad debts, many multiples higher than the UK or Ireland. So you're wrong to say that. The other countries, in fact, UK was much better off than many of the Southern Europe. Spain, Italy.
Well, actually, Spain survived well as a banking crisis. In a banking crisis, it relatively well. Italy, I accept what you say, but there was an awful lot of corruption in Italy anyway before the banking crisis. But it's factual to say that IAS 39 was not extended to subsidiaries. Now, we could argue as to whether it impacted more in the UK and Ireland, but it's certainly factual to say that in the rest of Europe, outside Ireland and England, the benefits of IAS 39 were not as, when I say the benefits, the toxicity of IAS 39 was not as strong. Now, they could have hit losses for other reasons. It could have been pure fraud. They could have got lost a fortune on derivatives, but certainly there was a difference in the way that the accounting standard was rolled out.
What we're going to do now, folks, thanks Ian and Cormac for that exchange. What we're going to do now is invite each of our speakers to just share any final comments, just briefly, anything else they'd like to share before we start bringing the meeting to a close. So first of all, we'll go to Ian Fraser. Ian, any final comment that you'd like to make, sir? And of course, thank you again for your contribution tonight. You might be on mute, Ian.
I think it's depressing that people of the stature of Cormac Butler and Tim Bush, who I know quite well, have raised this issue of illegal accountancy under IASB, and been largely, well, it seems certainly in Ireland, but I'm not sure about other countries, been largely ignored by the establishment. And I think this is partly to do with the power that's exerted by the big four firms, including PwC, EY, Deloitte, and KPMG, over the accounting standard setting bodies and over the supposed regulators of the accountancy profession. So that's my thought. I mean, I could say more, but I don't want to keep people waiting too long.
Ian, thank you very much. I share your fundamental concern that what should be happening in terms of getting the truth out there in the open and getting the authorities to take the right corrective action isn't happening. The system is sick, it's broken, it's corrupt. That's the inevitable conclusion, that all the evidence we keep seeing is taken us to. Thank you again, Mr. Ian Fraser. From one Ian to another, Mr. Ian Tyler, any final comments from yourself?
I don't think I've got anything more to say except just to remind people that, I mean, what Ulster did was particularly egregious in that they booked fraudulent liabilities and credit lines there because the customer never needed those. That is the fundamental point. That's, to me, is a fraud, and you don't get worse than that. So yeah.
Thank you very much indeed, and well said, Ian Tyler. Steve Middleton, you're next.
Yeah, I've been trying to expose this margin account fraud since 2013 when I first reported it direct to the FCA, and so I thank the TTF for giving support to airing this, because I always said it was the biggest fraud perpetrated. The idea, as a financial advisor, I sold investments to my clients to give them a better life, a better retirement, and to make money. The idea that I would sell an investment product to a customer that I expected them to lose money on, and I would be the beneficiary of all those losses, to me was completely anathema to what I believe about financial services. But it's been a battle against lawyers and barristers and journalists at every level who will say that the credit lines weren't real and the risk wasn't real. So again, thanks very much, Ian. Is the brilliance on the accounting side of things in putting this into real accounting terms has been a huge thing. Whether we'll finally get it exposed or not, I don't know, but I think we are moving forward at least on trying to do that.
Thanks, Steve.
So thanks all the speakers for the input on that. Yeah,
for sure. And thank you, Steve, for being the impetus for this particular line of activity that we're continuing to explore, and we will continue to explore until the end result that we're after is achieved. The end result we're after, of course, is compensation and justice.
Yeah.
That's what we have to carry on working for. It shouldn't be this hard, but it is. That's the reality of the situation. That's why we need to carry on working effectively together. Thank you, Steve. Let's go to Cormac. Really great to have you talking tonight. We hope you'll come back and contribute further in due course, yourself and Tim. Cormac, any final comments from yourself?
Well, first of all, thank you for having me as a speaker. These are important topics you're raising, even if there's practical difficulties in getting people to take action. Three things we have to remember, the one thing we have to remember is that even if we have corrupt judges and a corrupt legal system, if we can boil our arguments down to something simple so that everyone understands, it's going to be very difficult for judges to pretend that they don't understand what's going on. So the 3 points I think we need to remember are, first of all, there are hidden margins on these derivative contracts, and these derivative contracts should not have been sold to customers of Ulster Bank. They're not sophisticated investors, and if pension funds are having difficulty with derivatives, you can rest assured that ordinary customers will have even more difficulty. The second thing is that there have been other incentives within Ulster Bank to force people into bankruptcy, and their argument that we would never consider a potential future exposure as a reason to force people into bankruptcy is completely false. We have evidence that there was an incentive through the APA, the Asset Protection Arrangement, to claim insurance on bankrupt customers, and the derivatives through the potential exposure gave the bank an opportunity to force customers into difficulty. And thirdly, if the banks are not complying with company law, in theory, they should have difficulty enforcing swap contracts, which uses the term cost of funds. So if you can remember those 3 points and keep the argument simple, judges and legislators will have difficulty pretending they don't understand.
Fantastic, Cormac. Thank you very, very much. Thank you. In terms of my closing comments, I'm just going to refer to Operation Trident. Not everybody's familiar with this. I'll briefly run through it. Operation Trident, the concept was conceived at our last one of these meetings about 5 weeks ago, whenever it was. Operation Trident, because it's about getting the 3 parliaments working together, Dublin, Westminster and Stormont. I know Stormont's not a parliament in a strict sense, but you know what I mean. So it's vital that we continue to engage with the politicians in Dublin, Stormont, Westminster, get them on side, get them vocal, get them behind the idea that there needs to be a proper inquiry, there needs to be compensation, there needs to be justice. That's very much a work in progress. We're making continuous effort in that direction, and it's paying dividends. There's some cracking relationships being formed there. So Operation Trident, working towards justice for the victims of fixed rate loan and interest rate hedging malpractice, malfeasance, misconduct, mis-selling, and outright fraud by Ulster Bank Group, NatWest, RBS, through engaging with politicians and other key stakeholders in Stormont, Dublin, and Westminster. Other key stakeholders, of course, include key subject matter experts. We've had great speakers tonight, all of whom are key subject matter experts, plus the politicians, plus, of course, the media. We're very aware that there are one or two heavyweight publications that are paying real interest in this. And when that gets into the public domain, it's going to trigger some very proactive activity. I can't say too much right now, but we're going to be effective, folks. We'll wrap it up there. Thank you very much indeed. Your tenacity, your staying power has been great. It's coming up to 5 to 9, so almost 3 hours of pretty intense stuff. Thanks again for our speakers. Thank you all for being here. Onwards and upwards together. As always, that's the way to do it, folks. Thank you very much indeed. Let's give ourselves a round of applause for taking part. Thanks a lot. Thank you very much indeed. Bye, guys.